Bonds getting sold, oil getting bought, and the hottest ticket in equity markets today is a grocery delivery company. Live from Studio 2 at Bloomberg headquarters here in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you off to the closing bell here in the U.S. About 2 hours ago, it's not too pretty. You're looking at the S&P 500 down by about 0.3%. Big tech down by about 0.3%, we'll call it as well. Of course, on light volume as we await the Fed's decision tomorrow of that two-day meeting, widely expected to hold. All the while, you see 10-year yields down by about 3 basis points. Again, though, we're still above 4.3%, very elevated levels across the Treasury curve, and we have to talk about oil. Right now, crude oil, it's actually lower on the day, flipping into negative territory, currently off by about 0.2%, Romaine, but we know that earlier today, we were looking at $94 a barrel on crude.
Yeah, absolutely here, but let's start off with another sign of life for new stock listings here. We're talking about the new kid on the block, Instacart, the second marquee IPO in the past week, as the market for new issues leaves behind, finally, what was the longest drought since 2009. Now, the IPO specifically for the grocery delivery business was more than 23 times oversubscribed, with the top 10 clients taking about 65% of the shares offered. That was at $30 a piece. The stock just opened within the last hour, now trading right around 37, 38 bucks. That puts about $660 million into Instacart's pocket and gives a diluted valuation for the company of more than $10 billion. Now, while that's a fraction of the $39 billion valuation just a couple of years ago, it still ranks, of course, as one of the biggest companies to go public this year. I think some investors will take it. Meanwhile, crude oil continues to have its moment, as Katie was just saying, a 15th day of gains in the past 20 sessions for NYMEX crude, 15 days of gains that have pushed WTI futures from less than 80 bucks a barrel to as much as 94 in just 4 weeks' time. Erin Brown, the portfolio manager for multi-asset strategies over at PIMCO, she says higher oil prices could drive the S&P down by as much as 15%, saying that while FOMC policymakers are so focused on core inflation, costlier oil will actually boost durable goods prices, and that will feed in to hurting the economy, making it difficult for the Fed to meet market expectations of 3 rate cuts next year. It's an interesting setup, of course, for the FOMC, which today began its 2-day policy meeting at 10:30 a.m. Washington time, just as scheduled. One of at least 11 major central banks that are set to announce policy decisions over the next 36-hour stretch. Katie, policy decisions that some investors say likely represents the last gasp of this rate tightening cycle.
And if you take a look at what's priced into the market right now, that's broadly what's expected for the Fed. Right now, you have the Fed funds upper bound at about 5.5%. You look at what's priced in terms of the terminal rate for this tightening cycle, market's expecting about 5.6%. So maybe they go again, but really the finish line is in sight if you take a look at what bond traders are pricing. And of course, what we hear from the Fed tomorrow, from Fed Chair Jerome Powell, has many implications across the curve, not just for the front end, but also for the long end. And if you take a look at yields right now in the Treasury space, we're looking at year-to-date highs really across the curve, even on the long end. And you think about this sell-off, really, it's been going on for 4 months. And given the levels that we're at right now, Romaine, a lot of investors are saying it's time to lock in those rates. It's time to extend duration. But again, a lot of that hinges on what we hear from the Fed tomorrow.
Of course, that will be the big story of the day tomorrow. Ron Temple is here today, Lazard's chief market strategist, joining us right now to help kick us off to the close. And Ron, always great to see you here. And of course, on the eve of a big Fed decision, a Fed decision that most people say is going to be no decision, basically no change. But what do you think they could telegraph to the markets about whether this tightening cycle might actually be over?
Well, I think we're on the cusp of a monetary policy inflection. This is a really important week between the Fed, the BOE, the BOJ, and I think about 9 other central banks this week in emerging markets and developed markets. So we've got a lot coming down the pike. But what I'm really looking forward to from the Fed is probably that they're not going to make any promises. They're going to praise themselves subtly in terms of having had great success at getting inflation down without causing recession. But they're also going to talk about being vigilant. And it's going to be very important to basically remind the markets that they're the cop on the beat and they're basically willing to raise rates if they have to, particularly given what we've been seeing lately in the energy complex in terms of oil prices being up 33% in the last 2.5 months.
Well, let's talk a little bit more about that, because that does seem to be kind of the wrinkle in the ointment here. I mean, of course, we know the Fed backs that out because they basically make it explicit they really have no control, no direct control over those prices. But that's going to be a major issue for consumers should prices stay elevated at these levels.
I agree. It's nice that economists always say X food and energy, but the last time I checked, we all use it. And so it's really important to consumers. It's important to wage demands from consumers. And ultimately, even if you look at inflation X food and energy do filter back into all the other inflation. And my favorite, usually I use an example. If you're getting your hair cut, there are no commodities involved, but they do pay for utilities, right? They do pay workers who consume these, so it's really important. And I also think on a structural basis, there is a case to be made that energy prices will continue to go up for years to come, partly due to the energy transition and just the cost we're going to have to make to get away from fossil fuels. And frankly, climate volatility and climate change are likely to make food inflation a bit higher. So it's going to be hard for the Fed and other central banks to ignore these factors.
And of course, some of those non-core items, they do factor into inflation expectations. To your point, we all use food, we all use energy. And when you think about how that's being expressed in the market, when you take a look at break-even rates, especially on the front end, should they be higher right now?
I do think they should be. I mean, the markets basically have been for quite a while basically assuming that once we get through the next 12 months, it's back to low, stable inflation. And the way I look at that, by the way, is just look at the 5-year Treasury and look at the 5-year inflation index. And if you back out the next 12 months of inflation expectations, you're basically down to 2%. And so I think there's a little too much complacency there about structural inflation pressures. And those are pressures in many ways that central banks can't do anything about. Again, it's that energy transition. And it's also just the changing nature of global supply chains. And frankly, the rising cost of operating in China. A lot of people think about moving out of China, but honestly, workers in China have been getting double-digit wage gains for the last 20 to 30 years. It's just not as cheap as it used to be to operate in China.
And Ron, keeping that global perspective, you mentioned there's something like 1 million central bank meetings this week. If we boil it down to just 3, we have the Fed, we have the Bank of England, we have the Bank of Japan. Which bank has the potential to surprise markets the most here?
That's a really tough question. I think the Fed, basically the market is priced that nothing's happening, and the Fed historically does not disappoint the market positively or negatively. So I think that's unlikely. The BOE, the market is expecting the Bank of England to hike. Interestingly, in the last month or two, the expectations for the terminal rate or the peak rate in the UK has gone from 6.25%, 6.5% down to 5.25%, 5.5%. So there's been a big shift downward in terms of being less hawkish. I think there's room for surprise there in terms of the BOE and what they might say about expectations. I would have said the Bank of Japan.
Yeah.
But on the 9th, I mean, basically, Governor of Bank of Japan, Edison, had an interview where he talked about maybe by the end of the year we'll have the data we need to decide if we should think about going out of negative rates. That was the big surprise. So I think he kind of front-running himself in terms of the media headlines. So that's a long way to say I'm not sure, but maybe the Bank of Japan, if we get a reiteration from Ueda that the Bank of Japan thinks that they've won the battle against deflation, I think that would be a pretty significant surprise.
Yeah, that would be a huge structural shift, I think, at least for that part of the world, and I guess foreign investors invested there. I am curious here, Ron, about kind of how investors should sort of interpret where we are in this rate hiking cycle. If you do believe that they are done, then you must believe that market rates are either at or near their peak. So what does that mean in terms of the next decision that you make about what to buy or sell?
Yeah, I mean, honestly, this is the first time since the rate hike cycle began that I think the market is finally pricing things appropriately, meaning we've been too dovish for too long. When the market would finally get the peak rate, the terminal rate right, it would assume that the Fed would immediately turn on a dime and start cutting rates. And so if you look back, it was only a couple of months ago, 2-3 months ago, the market was saying Fed funds would be back at 4% by March of next year. Now it's saying we're basically not going to see a cut until the second half. So when I look at the markets, I think number one is if you're thinking about allocations to fixed income, it's looking pretty attractive. I think extending duration, locking in some of these higher rates might make good sense right now. I do worry that the equity market still doesn't seem to be pricing this in fully. And again, I have to be careful there because the equity market includes very different situations. Yeah. The equally weighted S&P is at 15.2 times earnings. The S&P is at 19.2. So this, to me, is an argument where if you've been passive and you've really enjoyed this ride up in equities, maybe now is a good time to rethink that and allocate to some of the parts of the market that have not worked.
All right, Ron, always a great conversation here. Ron Temple over at Lazard, helping us to kick you off to the close here. And of course, we are about 24 hours away from the Fed decision, full coverage starting tomorrow. Meanwhile, here today, a conversation coming up with Afsaneh Beschloss over at RockCreek. She's actually here in New York, over at the Plaza Hotel, where the Earthshot Prize is being announced, the annual award for companies looking to tackle the world's environmental crisis. We'll check in with her in just a second.
Plus, we'll talk to the CEO of Edison International about the growing demand for electricity as the nation switches to EVs and other clean energy initiatives.
And we're going to hear from an exclusive interview with Sir Tony Blair, the former UK Prime Minister, and his insights on what can be done to bridge divisions among the members of the United Nations General Assembly. That conversation and so much more coming up in just a bit. This is Bloomberg. Treasury Secretary Janet Yellen is speaking out on U.S. climate initiatives. In an interview that she had with Bloomberg Green, she said, "We're working as fast as we can to move this agenda forward. You'll remember for the previous 4 years, the U.S. was nowhere, was actively opposing climate. We've turned the ship 180 degrees around." Those are the comments that she made to Bloomberg Green here on the eve of what is today the announcement here of the Bloomberg's Earthshot Prize Innovation Summit in New York. It's down at the Plaza Hotel in Midtown Manhattan. And pleased to say that Afsaneh Beschloss, the CEO over at RockCreek, is joining us right now. She also sits on the board of the Rockefeller Foundation. And of course, she has been very instrumental and out front here and looking for better ways to create sustainable investment. Afsaneh, talk to us a little bit here about what's going on right now at this event and the amount of money that is being committed to fighting climate change.
There is probably more enthusiasm you can see today as compared to, I would say, previous years. What we're seeing is a lot getting committed. I think what Secretary Leyen just talked about, and we'll be talking about hopefully more, is moving the commitments to actual investments, because those have been going a little bit more slowly. There's the two sets of funds. One is public sector funds and money going into emerging markets, particularly those more affected by droughts and famine and other natural disasters, but also and caused by climate change, but also private sector money going in. And what I should tell you is that the private sector stuff is moving faster than the public side.
Explain to us why it's moving faster. Is that because there is greater opportunity for profitability, or is it simply, I guess, a signal of maybe greater sense of responsibility?
I think probably both, but no question that now you get returns that are very significant in clean energy, in water projects, in areas that are broadly related to climate. And as you well know, solar energy is now very, very accessible and economic. And as particularly you go into other areas outside of California, for example, there is huge potential. Similarly, huge potential on the aviation side. We've been investing quite a bit on alternative fuels for aviation, on looking at technologies for de-icing planes, really across the board. And all of these are very economic and high return projects. So you see the private sector coming in, and of course the IRA certainly helps. But I think it's the economics that has changed dramatically in the last 10 years.
Do you think that the private sector alone can fund this energy transition, or does the public sector need to catch up here?
Ideally, you want both, because public sector can set the policies, public sector can de-risk certain kinds of projects that you need. But at the end of the day, the scale of private sector assets that wants to go in this area is much, much higher today. And they're doing it for two reasons. One is they want to not invest in risky projects. If you're investing in old-fashioned traditional energy, that might be high risk in future. But you also want to invest in high return projects. And right now, the biggest momentum you have got is in the energy transformation that we're going through globally.
And what's the biggest gridlock, the biggest holdup, if you will, when it comes to that transition?
I think, if you talk to industry, permitting is still slow, whether it is in the US, whether it's in Europe, where you need to move out of coal power plants, let's say, into cleaner energy. Permitting is still moving much slower than you would like it to go. The other areas, I think, in terms of policies, like it took a while, quite a long time, for example, after the IRA money was actually available until the rules were clearer about how they could get applied. So if you could get the public side to clarify and define standards and define how this money will get used faster, I think that will be a huge impetus.
When you look at the money coming out of this particular competition, as well as money, say, coming out of that $1 billion initiative from the Rockefeller Foundation and other efforts to sort of foster sustainable investment, is most of that money going to emerging market projects, or are they also going to developed markets?
I think if you look at the Rockefeller Foundation and other nonprofits, obviously, that work on emerging markets, a lot is going into India, into Africa, into other low-income countries. Similarly, money is going from World Bank and other multilaterals, but also a lot of money going into the US and some into Europe and Asia. And let's not forget, China is producing, in terms of the growth of CO2 emission, the largest amount of CO2 emission growth is supposed to come from China, and in future probably from India, maybe it's distant second, and other parts of Asia in particular. So we need to really, really make sure that as we're making all these efforts we're talking about today, there's not additional CO2 emissions going into and creating the sort of essentially undoing the good that we're all doing.
Afsaneh, it's great to speak with you. Really appreciate your time. That is Afsaneh Beschloss. She is the CEO of RockCreek. Now, coming up on the close, get ready for a slowdown. The latest report from the OECD says that rate hikes going to weigh on global growth. We'll have the details next. This is Bloomberg.
As the world's movers and shakers gather in New York for UN Week, the global economy appears set for a slowdown. That's according to the latest forecast out of the OECD. Interest rate increases and China's disappointing pandemic rebound means GDP growth worldwide will slow to 3% next year and 2.7% in the year after. Bloomberg Economics Chief U.S. Economist Anna Wong joining us right now to talk a little bit more about this. I mean, 2.7% growth a year or so out still seems pretty healthy, but well below where we've been over the last few years, Anna.
Yeah, that's right. I mean, for global growth to be negative, it's actually extremely hard because you have, China, which is the second largest economy, and even if there is a significant slowdown in China, China's GDP growth is still in positive territory. So I think that number you just posted there does tell you that so it's not the level of growth rate that matters. It's the momentum, and it is definitely going down because of lags of all the rate hikes around central banks in the world.
It's interesting when you go by region and country by country, as you see on the screen there. The biggest changes, of course, to the downside were the revision for China and the revision for the euro area.
Yeah, that's right. I think the surprise this year was that how weak euro area and China had been. So coming into the year, everybody thought that maybe Europe will go into recession early in the year during the winter, but they were resilient, and everybody thought they were out of the bad phase. But it turned out that later in the year, the rate hikes from ECB finally caught on to the European economy, along with China's slowdown, which tends to affect Germany disproportionately because Germany is very much exposed to the global manufacturing cycle. So the war on between Russia and Ukraine didn't do Germany in, but the rate hikes and also China's slowdown did do them in.
And when you look at the situation in Europe, how big of a risk is a stagflationary type environment right now?
Yeah, I think that I would call it a stagflation light risk because we are not back to the 1970s world where oil price tripled. We're talking about just 20% increase in oil price. And also, in the past year, both Europe and U.S. has accelerated the transition to green, green energy. So I would say that the resilience, do not underestimate the resilience of economy to energy prices. But I will say that growth definitely will slow down a bit from higher energy prices, but not in the sense of, the 1970s kind of situation.
And so, Anna, clearly we've seen rate hikes catch up with the European economy. When you look at China, though, how much of that can you tie back to monetary policy, or is this just a case of demand not coming back as maybe the rest of the world thought it would?
It would be the latter, Katie. So I think China's problem is more of a scarring from post-COVID, especially with the slump in real estate. And China's growth in the past 20 years has very much been intimately tied to its real estate market. Every time the real estate market goes down, you start having capital flight issues from China. And by some economists' estimate, given the intersectoral linkages between the sectors in China, the real estate sector could contribute as much as 40% of GDP growth in China. So for China, it is definitely more of a scarring from the years of COVID closures.
All right, Anna Wong, our chief U.S. economist over at Bloomberg Economics, down in our Washington bureau. A look at the global economy here and the revision downward in the OECD estimates, Katie Greifeld. And it was interesting here. We had one of the main economists over the OECD. They were on with Bloomberg Surveillance a little bit earlier. Also, they're talking about the slowdown in growth, but they're also saying that these central banks need to stay the course. They're actually saying that we could actually need more rate hikes in order to tame inflation. It's
that delicate dance, right? Trying to bring in inflation while not totally killing growth. It seems like a lot of people are optimistic that the Fed maybe is out of the woods there. Maybe that mystical soft landing is achievable. But you think about the rest of the world, particularly Europe, it's a much more narrow path. Yeah, meanwhile, here on the eve of that big Fed decision, we have a market well off the lows of the day, but still pretty much red across the board. One bright spot in the insurance sector. And we should talk about yields right now. Katie Greifeld, yields across the board right now near session highs. 509 on the rate-sensitive 2-year yield. Romaine Bostick alongside Katie Greifeld. This is The Close on Bloomberg. This is the countdown to the close, almost 2:30 here in New York. An eye on the broader markets, which remain in a bit of stasis ahead of a big Fed decision tomorrow, but a lot of volatility going on in the commodity space. Abigail Doolittle is standing by right now with our commodities close.
There really are some outsized moves here, Romaine. Take a look at natural gas, both here in the U.S. and European, and it seems to have to do, at least for European, the fact that Norway's Troll field is set to halt production on Wednesday, so that could add to fears around tight supply. We, of course, still have that strike, I believe, happening in Australia, LNG supply possibly 5 to 10% of the world's LNG supply off of the market. As for wheat, down 1.3%. So it's interesting because the first grain ship since July has left the Ukrainian Black Sea port, defying the Russia trying to say that Ukraine cannot ship wheat out on that increased supply. We have wheat down 1.3%. Dr. Copper down 0.7%. So a little bit of a risk-off tone here. That's really accumulated by oil. We have oil fluctuating on the day, small gains and losses after having been higher earlier. What's so interesting here, Romaine, is if we go back in 2021, if you recall that big spike above $100 per barrel, we then had a bit of a collapse, just too far, too fast. It almost appears as though we might be setting up for something similar. This doesn't mean we couldn't still go up to 100 and then come back down, but it seems as though this rise might, in fact, at some point relatively soon prove somewhat unsustainable. Yeah, and for anyone interested in those technical levels, definitely put that into the Bloomberg terminal, and you'll see just how wild this day has been. Meanwhile, we turn back to the push to move away from fossil fuels and to cleaner forms of energy. There's a new report out from Edison International that looks at the growing demand for clean energy and how it could put unprecedented demand on electric grids.
By 2045, in the state of California, electricity demand is expected to jump by 80% or more as 90% of vehicles and 95% of buildings become electrified. Joining us right now is the president and CEO of Edison International, Pedro Pizarro, here in our studio here in New York. Great to have you here, Pedro.
Thanks for having me.
You are going to be a busy man if you haven't already been here, because with all the talk about how we should all be maybe potentially moving to alternative fuel vehicles and other sort of forms of clean energy, there's a big discussion that has to be had as to whether the infrastructure is there to support all that. You run, obviously, a big electrical grid here. Have you actually seen an increase in, I guess, pressure on your electrical grid as a direct result of the adoption of EVs and other forms of renewable energy?
Absolutely, and it's moving faster than we expected. So a few years ago, we thought that load might stay flat to 2030. Now we see that it's growing at least 2% a year. Here's the good news, though. As you look across the entire industry, my colleagues and I in investor-owned utilities invested around $150 billion last year. 30 billion of that was for transmission. As we look at a report countdown to 2045, we see the need to continue that investment to address that 80% or more increase in load. What's important about that, there's a couple of things. One, it is a big lift for the state of California, world's 5th largest economy. We see needing to invest around $370 billion between now and 2045 across the power sector in California to make all that happen. But there's a good punchline to that. Because electric technologies are much more efficient than fossil fuel technologies, our average customer may see their electric bill go up and their usage go up, but their total energy bill, gasoline plus gas plus electricity, be 40% lower by 2045. So there's a co-benefit to this transition.
I'm just curious, and forgive me if this is a dumb question, but when we talk about sort of building up the grid, does that mean you have to build new power facilities, or do you just take the existing ones and make them more efficient? What does that mean?
It's all of the above.
Yeah.
And we see needing about 3 times the clean energy resources on the grid in 2045 that we have today, going from around 40 gigawatts to around 120 gigawatts. So it's adding renewables resources. It's adding storage to balance that out. It's adding grid, right, to move it all around. If you look at the historical rates of transmission additions, we think that we will need to have 4 times that rate as we move towards 2045. If you look at the additions for the local grid, the distribution grid, 10 times what we've had historically. So it's a massive investment that's needed. But again, that's to achieve what we think is the most reliable and affordable way to get the state's economy to net zero. And the lessons from California are ones that apply nationally and globally.
Well, when you think about the loftiness of these goals and some of the massive investments that are needed, $370 billion is quite a big number.
No.
Do you think net zero in California by 2045 is a realistic goal?
It is a realistic goal. But one of our messages in the paper is that we do need to preserve optionality. So right now the state has a net zero goal. It has a number of other point solution goals too. And so one of our messages is, let's retain some flexibility. Let's continue to evaluate this, because the reality is, sitting here in 2023, we don't know with certainty how each technology will mature. We know we'll need all of the above. We'll need renewables. We'll need small modular reactors. We'll need geothermal. We'll need offshore wind. The pace of development will be different across technologies, so we want to make sure that we preserve the optionality to check and adjust and follow the market. Carbon capture will be another big part of the equation, so we want to make sure the state can access all of these technologies as they mature.
And before we get to 2045, let's just talk about the here and now in the past couple months, because extreme weather has become very common when you think about extreme heat, of course, hurricanes and the like, and fire season.
Right.
How worried are you about the next couple months, next couple years?
Well, I'll give you 2 answers to that. One is climate change will continue to manifest itself in extreme weather. We had a paper a couple of years ago, Adapting for Tomorrow, that talked about what's coming. 20% more fire risk, around 3-foot sea level rise, more droughts, more floods. But here's the key thing. Our industry, and certainly our company, we are investing to harden the grid, and I think the whole economy will need to do the same. So the wildfire example, just in the last 6 years, the investments we've made in things like replacing bare wire with insulated wire and adding new technologies has decreased the probability of our equipment starting a catastrophic fire by 85% compared to pre-2018. So our industry is continuing to use new technologies, make investments that make our community safer.
Pedro, really enjoyed this conversation on what is a very busy week for you. Hope to check in before 2045. That is Pedro Pizarro, Edison International CEO.
Me too, Katie, if I'm still around.
We'll pencil it in. Still ahead, though, on the close today, the turnaround that investors of VF Corp were hoping for is taking a little longer than expected. It's part of the reason why Piper Sandler downgraded the stock. We're going to talk to the analysts behind that call next. This is Bloomberg.
All right, time now for our top calls, the big movers on the back of analyst recommendations. And we start off in the cruise ship space. Truist adjusting its view on the sector, and that led to an upgrade to buy for Royal Caribbean. The analyst saying trends point to upside for bookings and pricing and earnings expectations for some of these cruise line operators. They're actually a bit too conservative in the eyes of that analyst, especially for Royal Caribbean. Those shares having their best day in about a month. Next up, let's take a look at Deere, the farm equipment maker, getting cut today to inline over at Evercore ISI. The analyst actually saying that there's not a whole lot of visibility in this sector and saying there's a lot of revenue risk for the agricultural sector, including Deere and CNH. Deere shares down about 3% on the day. And finally, let's take a look at Starbucks, a downgrade for the coffee chain over at TD Cowen to market perform. The analysts over there chalking it up to macro pressures here and comp sales issues over in China amid increasing competition from cheaper stores. Starbucks shares down 2%, having its worst day in about a month, and those are some of our top calls. We do want to stay in the area of consumer spending and look at some of the changes there, particularly when it comes to clothing and apparel and inventory levels, where the crux behind a recent change in ratings over at Piper Sandler and their view on footwear companies, VF Corp and Skechers. Pleased to say that analyst over at Piper Sandler is joining us right now. Abbie Zvejnieks actually downgraded VF Corp to neutral and upgraded Skechers to overweight. Abbie, let's start off with VF Corp here and give us a sense here as to why you're seeing some material softness there.
Yeah, so I think our previous overweight thesis was based on a Vans brand turnaround. The brand got over-inventoried, rely too heavily on core classics, and we are starting to see, some traction from new styles, new product that they're putting out. But I think that the current state of the wholesale footwear environment in the U.S. is going to make it challenging. The timeline of that Vans brand turnaround, we have less certainty around, and that was really the reason for our downgrade. There's still too much inventory in the channel. Open-to-buys are extremely tight for wholesale retailers. And I think, when open-to-buys start to open back up, they're going to favor brands that are seeing strong sell-through in the channel right now. And unfortunately, Vans is not one of them.
Well, okay. Well, let's talk about Skechers then. Is that just like the hipper thing right now? Is that what kids are buying?
I don't think it's necessarily that kids are buying, but they're seeing strong direct-to-consumer trends, which indicate strong underlying demand. They've had a lot of new product. I don't know if you've seen their new slip-ins product, but it's a technology that you can slide your foot in really easily, and you can use that in an array of silhouettes. And so that's seeing really strong traction with consumers and strong sell-through in that wholesale channel. So we think that restocking will occur as those open-to-buys open back up. And there's also Skechers business is 60% international, and we're seeing really strong growth there with, some tailwinds in China for that recovery as well.
And given that, so much of the growth is coming from overseas, we spend a lot of time talking on this program about potential cracks in China. Of course, the rebound over there hasn't been as strong as maybe some had predicted earlier in the year. When you think about China in particular, how much of a risk is that potentially?
Yeah, so Skechers' expectations have been really tempered when it comes to China, and I think the CFO John Vandemore has been very clear that they're not expecting a linear recovery in China, and so I think that successfully have baked into guidance a conservative view on recovery in that market, which will be a benefit in the future. Although they are seeing better than expected trends in that market, and so I think coming away from a conference that we just had, our Growth Frontiers conference, where the CFO spoke, I actually felt more optimistic on growth in China in the near term.
And Abbie, I just want to go back to VF Corp and your downgrade there. Of course, the Vans turnaround maybe not going as rosily as expected. But when you think about the rest of VF Corp's portfolio, what else under their umbrella could maybe temper what we're seeing out of Vans?
Yeah, that's a good point. The North Face brand has continued to produce strong growth. It grew 17% constant currency in their last fiscal year. And so, I think that they've successfully capitalized on secular tailwinds in outdoor and active, and have introduced a lot of great new products, which, is the thesis that they can use this same playbook now with Vans and in this turnaround. There's some other smaller brands that are doing well, including the Ultra brand, which, is a running shoe brand. We're still seeing a little bit of weakness in Timberland and Dickies, but, upside could come from that North Face brand, in my view.
All right, Abbie, great to catch up with you here. Great insights. Abbie Zvejnieks over at Piper Sandler. An interesting upgrade and downgrade, a pairs trade, if you will, Katie Greifeld, on VF Corp and Skechers.
There you go. Skechers is cool.
Sir Tony Blair, you know him. He's a former UK Prime Minister. He actually had a chance to sit down with David Weston to discuss why the AI revolution should be a top issue for politicians. We're going to tell you what he had to say after the break. This is Bloomberg. Welcome back to The Close. It's time now for Wall Street Week Daily with the host of Wall Street Week, David Weston. And David, I heard that you had a chance to sit down with the former Prime Minister of the UK, Tony Blair. Yeah. He's got a lot going on these days in his post-Prime Minister life.
No question about it. And he's in New York, of course, for the UN. And we did talk about AI, as you suggest, Romaine. But before that, we started with some of the world conflicts. This is Tony Blair, former UK Prime Minister and founder of the Institute for Global Change.
You've got a very divided world today, and a lot of the institutions have grown up on the basis that everyone can come together essentially around an American-centric view of the world. And you have Russia, you have China, you have countries that don't want to be aligned either with America or with China, but want to keep in with both. So you've got a completely different world that's evolving, and the institutions were all created for a different time. So even the UN Security Council, when you think about it, I mean, it's completely irrational that you don't have Germany or Japan or India, Brazil, Indonesia, large countries that aren't represented in the permanent structures of the UN. The difficulty is, how do you change those institutions when you require everyone's consent to do it? So I think you're going for the foreseeable future. There will be issues around which people come together, global pandemics, potentially climate change, maybe stabilizing the global economy. There's areas, of course, where America and China are going to have to work together. But the world is multipolar and polarized around essentially, I think, two blocks that are emerging. One of countries that are close allies of America, the other which are allies of China.
One of the areas where there is continued tension is something you know terribly well, which is the Middle East. You spent a lot of time over there, I know, particularly on the Palestinian issue. Now we hear that there may be the makings of a deal with Saudi Arabia, the United States, and Israel. What do you know about that? What are the prospects for it? I think you still advise the Saudi government, do you not?
Yeah, we've a close relationship with many of the countries in the region. We have a team of people work on the modernization program there in Saudi. I have an office in Israel and also in the United Arab Emirates. Well, the whole of the Middle East is undergoing a huge change. And I think the essence of the struggle in the Middle East really revolves around the desire of people there across the cultural spectrum, right? Whether you're in the Jewish state of Israel or in predominantly Muslim countries, the desire of people to move towards what I call rule-based economies and religiously tolerant societies. And when you look at the modernization program, for example, that's going on in Saudi or in the United Arab Emirates or elsewhere in the Gulf and Qatar, Bahrain, and so on, you can see that it's illogical for those countries to be hostile to Israel.
Let's turn to British politics, if we could, a bit. You've had something to do that in the past. According to the polls, if they're to be believed, the Labour Party, your Labour Party, seems like it's in reasonable good shape for the next election. We never know till the election happens, but in reasonably good shape. You were famous for New Labour, as we came to understand it in Britain. Is there room for a new Labour? Is there a different version of what the Labour Party did back in your day?
Yes, I think there is, and it's all around the technology revolution. I mean, in my view, the single toughest thing for politicians today is to get their heads around what is the big real-world event. I mean, leave all the things aside, all the things we're talking about in geopolitics, America, China, and so on. The big real-world event is this technology revolution, and particularly with generative AI, it's going to change everything. It's going to change the way we live, the way we work. It should change government, by the way government operates, the way public services operate. It's got enormous potential to change the healthcare system for the better. But then there are huge risks because it's a general purpose technology. You can use it for bad as well as for good. So this is the biggest challenge. And I say to people on the progressive side of politics, the progressive mission for the 21st century is how you understand this revolution, master it, and harness it. And that's because interesting, when you look at the 19th century Industrial Revolution, it took politics a long time to catch up with the real world event that was happening. And if we're not careful, it'll be the same today, because the policymakers and the change makers often inhabit different spaces. We need to bring them together. We need to see what the opportunities are, see what the risks are. But this is, for me, if I was back in government today, I would be reshaping the whole of the government agenda around it.
Great Britain had a little something to do, as I recall, with the Industrial Revolution, but you were bestride an empire at that point. That empire no longer exists. Is Great Britain large enough to really help drive the generative AI revolution?
Well, it can be part of it. And it's already one of the leading countries on AI. We've got a strong university sector. We've got a great life science sector. We have one of the greatest AI companies in the world, DeepMind, in the UK. The UK technology sector is thriving. We need to keep this and we need to develop it. But no, Britain, if I had to characterize the economic niche for Britain going forward, one major part of it would be around being an AI hub for innovation and development.
What about the future for Brexit and what happens with the UK? Sir Keir Starmer has said that he'd like to kind of revisit that a little bit. You've been very outspoken about your views on Brexit in the past. How far can the UK go? How far should it go to try to reintegrate with Europe?
So it's hard to judge because look, we got out of Europe. It was our major trading relationship. We ruptured our trading relations with Europe, but we also now are out of the political union of our own continent. And in a world where it's going to be dominated by America, by China, possibly in time India, those will be the three giants of world politics. You're going to find around the world people coming together in regional blocks in order to be able to sit at the same table as the giants. Right? You can see this happening all over the world. So for Britain to be absent from Europe is a real problem for us. However, having left it, getting back in is a tricky, tricky negotiation. There's an economic aspect. I think there are certain things that can move us closer with Europe without going back into the European bloc. But then I think there's a question of the political dimension to this. And there is a suggestion that we build a broader European political community. President Macron's talked about this. And Britain, I think, can play a part there. And in areas like defense or energy or science and innovation, you know, we can build those blocks of cooperation with Europe that move us closer. Whether we get to a stage where Britain rejoins the European Union, I think that's for a future time. But you know, you should never forget that 2/3 of the population over 65 voted for Brexit and 2/3 under 35 voted to stay.
That was Sir Tony Blair. He is the former British Prime Minister. And then on Friday, Romaine, you'll forgive the pun, we're going to shift gears back to automobiles. We'll welcome back Steve Rattner. He's Willard Advisors Chairman, who, of course, was the car czar. He said there's going to be a strike. There is one. Now we'll ask him how we're going to get out of it. That's on Wall Street at 6 p.m. Eastern time on Friday.
Yeah, I just want to know when the strike's going to end.
Yeah, that's what we all want to know.
Of course, be sure to tune in to David Weston on Wall Street Week on Friday evenings, and he appears every day around this time right here on The Close as we round into the final hour of trading here here on this FOMC Eve, if you will. A market still in relative stasis, well off the lows of the day, but not really going anywhere till they get maybe some potential clarity out of the Fed at 2 p.m. Washington time tomorrow. Full market coverage tomorrow with the team Bloomberg Surveillance and your team right here on The Close. A lot more coverage coming up right here on this Tuesday. Stick with us. This is Bloomberg. Almost 3 p.m. here in New York. This is the countdown to the close. Romaine Bostick here in Studio 2 at Bloomberg headquarters in New York.
Katie Greifeld as well, counting down to the Fed decision. This is pretty exciting.
Are you really excited by that? Because I'm told they're not going to do anything.
Apparently, but it's all about what Jerome Powell says, what the messaging is, what those dots show. I don't know.
Do you think he's going to be more forthcoming this time around?
You never
as opposed
know.
to the other times?
One of these meetings, he's going to surprise us.
One of these meetings, he is going to surprise us. Look, we are supposed to get those economic projections, the SCP, and that could actually be a big market mover.
Oh, big time, especially when you think about the debate over 2024 right now. Will they cut rates to normalize, or are they going to have to hold higher for longer to really make sure we have inflation lift?
Well, the view from the top, well, not a whole lot to look at here with the NASDAQ 100 down about 0.4%. Now, the good news is we're well off the lows of the day, but right now testing some key technical levels. And I thought this was interesting. I came onto the show today. We're all prepared to talk about this massive rise in crude oil. And Abigail Doolittle set us straight during the commodities close about 30 minutes ago. Interesting reversal here. And she says when you look at technical levels, seems to suggest that we could actually start to move down on crude prices.
You know, it's a real bummer when the narrative flips in the hours leading up to the show. But I mean, we'll see if this is a sustainable leg lower, whether, you know, maybe we hit some key levels and market participants are rethinking how far we've gone. But I mean, if you think about where we were, it's been quite a rally. Yeah, let's flip up the board real quick here, because I was taking a look here at the term premium. Of course, this is basically just what you get paid to take out duration risk, more or less here. The longer out you go, of course, in general, you want to get paid a little bit more. That has not necessarily been the case on a yield basis. You're actually still in the hole on a negative basis, but you are now starting to see that term premium get back to that waterline here. And it'll be interesting. There was an interesting note out by the folks over at Mizuho, kind of talk about this idea here that there is a little bit more conviction here that that trend will continue. And we'll see how that develops. Of course, that negative term premium has been bedeviling bond investors. But let's get to some of the single stock movers. I want to talk about Amazon really quickly. They plan to hire 250,000 logistics workers heading into the holidays. That's higher than previous years. Maybe that's why you see the stock down 2%. That has implications for broader markets as well. Let's also talk about Ford, of course, the United Auto Workers Union saying that more of its members will go on strike on Friday unless we see substantial headway. And it's interesting. You actually have Ford shares higher a little bit today. Yeah, the automakers have actually held up pretty well, at least so far. Investors aren't too phased. Yeah, we'll see if that changes between now and Friday. Let's also talk about Instacart. Of course, one of the big stories, it's the fourth biggest IPO of the year in the U.S. Shares up 22% in their debut. The valuation, I believe it's around $12.5 billion on a fully diluted basis. That's a pretty steep plunge from that $39 billion valuation in that funding round in 2021. But still, shares really rising today. Yeah, still some optimism here that at least a major company can come to market. Two major companies just in the past week alone. So maybe that signals that investor appetite is shifting and maybe market conditions as well. Right here on this Tuesday afternoon, we are about 1 hour away from that closing bell. Our cross-platform coverage, counting it down to the close, starts now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues in the radio booth, Carol Masser and Tim Stenovic. Welcome to our audiences across.
It's just me.
Wait, what's happening?
I've got good news and bad news.
It's just Tim Stenovic.
Okay. The good news is I'm here.
Okay.
The bad news is Carol's not here.
Okay.
But she's coming here soon.
Okay, well, I know Carol, the pride of New Jersey, by the way. Did she get held up by transit issues? Because I've been reading all about New Jersey transit is just a mess, and anyone trying to get into work. Was that the issue?
Fortunately, she walked. I told her to walk because New Jersey Transit has been having issues.
The reason you know there's a river separating us. So.
She walks on water.
There's a bridge you can get across.
Oh, okay.
Yeah, you can do that.
I've heard about that.
So
a tunnel too, that I don't think you're supposed to walk.
You cannot walk in the tunnel.
Yeah.
No.
I actually saw
You bring up a good point, Romaine, because anyone who's ridden New Jersey Transit has also probably complained about New Jersey Transit. We're getting some new stats about the on-time performance rate of New Jersey Transit. It's not just you. It has been below its goal of 94.7%. It's fell to a low of 88.9%. That was back in July. The reason we're talking about this is because companies are calling workers back to the office, Katie. And if they can't get from New Jersey to New York and back, well, it's going to be hard to get to the office.
Yeah, you know, New Jersey, it's trying its best, but did it give a reason why?
Are they?
Like, why have delays picked up? Is this a labor issue? What's going on?
No, I mean, there's some unplanned things. There are some outages. It's actually interesting that you say that because New Jersey Transit pushed back and said, if you take out Amtrak and other preventable delays from the calculations, the on-time rate was actually 94.1% in July and 95.8% in August. So, Romaine, you're laughing.
So if you remove all the things that actually affects on-time delivery,
the data,
they're totally on time here.
This reminds me of like adjusted EBITDA or adjusted earnings
Super
per share,
core
right?
inflation.
Yeah, it's like if you just play with these numbers and remove those one-time events, you know, delays, then the numbers actually look okay.
Well, that folds in kind of neatly to what I want to talk about, which is earnings, because over the past few seasons, I mean, companies have been talking about inflation, they've been talking about recession, but Bloomberg actually crunched the numbers. There's a new word that companies have been warning about on earnings calls. It's geopolitics. Apparently, if you look into it, S&P 500 chief executives have used the word geopolitics almost 12,000 times this year. That is almost 3 times as much as they did just 2 years ago. And it really tells you a lot about the global economy right now.
Yeah, I mean, I guess this isn't surprising. I mean, given all the ructions, of course, with the relationship between the U.S. and China, the potential rise of India, the war in Ukraine with Russia, and of course, you know, whatever the heck is going on with Taiwan, North Korea, and some of the other states here that we have to deal with.
Yeah, I guess the big question is to what extent is this like a new world economic order? It's the big take. It's what we're focusing on in the first part of our show today as well, guys. Bloomberg Economics crunched the numbers and found that of the $1.2 trillion in greenfield foreign direct investment invested in 2022, close to $180 billion shifted across geopolitical blocs from countries that declined to condemn Russia's invasion to those that did, according to the analysis. So does that stick? And also, how porous is that?
And we'll also see, I mean, we talk so much about supply chains, onshoring, friendshoring. It just feels like there's a lot of fundamental shifts that are going on in the economy right now. And Tim, to your point, how sticky is this? I mean, once you start to shift your supply chain, it's pretty hard to undo that.
Yeah, absolutely. And it'll be interesting to see how long this continues, right? Then the next earnings season, which is just around the corner, do we actually see go from 12,000 mentions or whatever you said, Katie, to, I don't know, something higher?
1 million?
Maybe
that
just
would be something.
Adjusted EBITDA all over again. That's what we're going to be focusing on, community adjusted EBITDA. Guys, that's going to do it for now. When I come back, Carol's going to be back here with me.
No.
So
Do
don't
you promise?
worry. Yeah, I promise.
Okay.
We'll be back again live on TV, radio, and YouTube on Bloomberg Quick Take, 4 p.m. for our Beyond the Bell coverage. We're going to take you through today's market close.
We continue to count you down to the close here on Bloomberg Television. We should point out here, volatility really starting to pick up in all of the markets across the board. We saw it in commodities early, including in equities and now in the Treasury space. Your 10-year yield, 4.3586 and change at one point just a few minutes ago, actually hitting its highest level since 2007. Sonia Meskin joining us right now, Bank of New York Mellon's head of U.S. macro, to help us count you down to the close here on this Fed Eve. Is this a spooky eve, or should we maybe be encouraged about what we're going to hear tomorrow?
Well, to your point just earlier, you know, if you've tortured the data long enough, it will confess to anything you'd like, and the Fed is expert at it as an organization.
Yeah, I mean, what exactly is, I think, what are you expecting to hear, or what do you want to hear more importantly? We know they're not going to change policy, at least that's what's been telegraphed for tomorrow here. But we are going to get some economic projections, and we're expecting some pretty significant revisions there. And of course, then Powell has to come out and jawbone the market to do what he thinks he wants the market to do.
Exactly. And, you know, I wonder, on the one hand, I think they really want to sort of watch for how the economy evolves into the end of the year and early next year. On the other hand, they clearly have to upgrade their growth expectations for the year, their inflation expectations for the year, and downgrade unemployment. And all of that points to at least one more hike this year and more hawkish dots into 2024. So he's going to have to, you know, play that message really carefully on the one hand. as well as the fears that potentially they will over-tighten in 2024. On the other hand, he can't just stay, on message that we're just here, waiting and watching when they're upgrading the projections.
How much are those over-tightening fears a real risk in terms of what could happen? Because we were talking about this yesterday. You look at the last few rounds of jobs data in particular, you see a cooling. But how worried are you that that could turn into something maybe more destructive?
Well, I think we're in the bifurcated market now. We do have higher rates that I do think is weighing on stocks other than major tech stocks. So this rally in stocks has really not been that broad and is having a tough time broadening out precisely because rates are high. So rates may bite in some sectors more than in others. And at what point this spreads to the rest of the economy and results in massive layoffs is a really hard thing to time.
Well, I want to talk about that a little bit more, the fact that you do have higher rates biting in some areas of the market, but not in big tech. And I mean, when I grew up, people told me that it's big tech that suffers when you have interest rates go like that. When does it start to hit big tech, if at all?
It's a great question. I do think AI is playing a big role here, and expectations for growth in big tech have just been ratcheted up. So I think the market is pricing in a significant growth over at least the next 5 years for these companies, which is making them much less sensitive to higher rates.
Is the type of growth that we see in those companies, and more importantly, what's being priced into the market in terms of growth expectations, is that synced up with economic reality?
It may or may not be, because one of the questions for AI is how quickly it gets, it becomes accessible to small to medium-sized enterprises. Right now, it's all still in big tech, and estimates around that vary really widely.
Are we setting up for a massive reality check here? Because, I mean, looking through the last earnings season, I feel like the message was that AI, it's going to take a while to translate into the bottom lines of these companies for them to actually accrue the benefits of that. And when you think about how much optimism is priced in, are we just setting up for an accident here?
I think what could potentially happen, to your point, is that rates may begin to bite a lot more next year for corporates that don't have these optimistic growth expectations priced in. So everyone who needs to refinance into a higher rate environment in 2024 is really going to feel the brunt.
I want to get your thoughts before we let you go here, Sonia, about what we've been seeing in the commodity space. Obviously, the big jump in oil prices, somewhat moderating today here. When does that become a concern for the Fed? I know Powell is very quick to point out the Fed doesn't really control energy prices. They would love to just ignore it. But real people, as I'm sure you know, can't ignore higher energy prices.
Absolutely.
Yeah.
I think the longer energy prices stay higher, the more this starts feeding into input costs across the board, both goods and services. And of course, you have to incorporate that into your projections. We did have the shale revolution in the last business cycle that really suppressed energy prices. And if you look at how break-evens reacted, they also moved to the downside pretty sustainably with the shale revolution effect. That's no longer the case in this cycle.
All right, Sonia, really appreciate that preview of that big Fed decision tomorrow. Our thanks to Sonia Meskin of BNY Mellon. Now, coming up, we're going to talk with Kendra Scott, founder, executive chairwoman, and lead designer of the Kendra Scott jewelry brand, and get her insight on the health of the consumer. Plus, we're going to check in with the latest stock to pop here. Maple Bear, the share is up about 20% here, selling shares at $30. Opening at 42. Katie Greifeld, though, a little bit down here at 36, right as we move closer to the close. Still up 20% or so, and we're going to count you down to that closing bell with Jurrien Timmer, Fidelity Investments Director of Global Macro. All that and more coming up. This is Bloomberg. About 45 minutes until we get to the closing bell. Take the price action today with a bit of a grain of salt. Similar to yesterday's price action, it's a market kind of in relative stasis right now. There are some individual stories that are moving stocks higher, and in some cases, in the case of Disney, moving them lower. But overall, this is a market waiting for, well, one person, Jay Powell. The big Fed decision is at 2 p.m. Washington time tomorrow. The press conference right around 2:30 here. And what he says, and more importantly, what those economic projections out of the Fed say, are going to be a big determinant here of the type of price action that you see
post-Fed meeting. As of right now, we're basically in a holding pattern for most of the major indices, down fractionally on the day, though we should point out volatility is elevated, particularly when it comes to the yield space here. You have your 2-year yield right now camped out around 5.1, and your 10-year yield just a few minutes ago actually hitting the highest level since 2007. NYMEX crude has also had an incredible ride here. At one point on the day, it was flirting with $94 a barrel, though it's peeling back just a little bit down around 91 here. But the damage is done here, Katie. The market setting us up here for what we're going to learn in about 23 hours' time. Not only what the Fed does, but more importantly, what they think of economic conditions.
And Romaine, looking past the Fed decision, fall's just a few days away, which means we're pretty close to the rush of holiday shopping that comes with it. And that's theoretically good news for the jewelry industry, and particularly for brands like Kendra Scott. Of course, this brand, it offers quality designs at what it says at an affordable to mid-range price. And we welcome now Kendra Scott to the show. She is founder, executive chairwoman, and lead designer of the Kendra Scott jewelry brand. Kendra, it's great to have you with us. And before we get to the holidays, I want to talk a little bit about this inflationary environment that we're in. We've seen plenty of sectors of the retail industry hold up to it, particularly skincare. How has the jewelry business been faring?
You know, for our customer, you know, we've really been able to look, first of all, we're aware of it, right? And we always want to bring value to our customer. And so we're really thoughtful about how are we going to do that? We know that she's hurting right now in other areas. So we've been really, you know, trying to stay true to what our pricing has always been. Great quality at an attainable price point. And, you know, you look at our customer base and we have such a diverse customer. I mean, 82% in the United States makes under $100,000 a year. That's over 50% of our customer. And that customer base, we continue to bring her value. And I think that's going to be really important this holiday season, especially, you know, moving forward.
Well, talk to us a little bit about the upcoming holiday season and how it might be different from past ones. When you think about coming out of the pandemic, obviously things got a little bit skewed. Inventory was an issue for a lot of retailers. How has it been at Kendra Scott?
Well, one of the things, you know, fortunately, we started to do early in 2018 is we really started to diversify our manufacturing. We started to go into other countries. We were, you know, very much in China for a while. Now, you know, less than half of our manufacturing is done in China, and we're diversifying to India, North America, Vietnam, Thailand, even Mexico most recently. So I think that's been really important, and that's been able to get ahead of some of these supply chain issues that you see a lot of our competitors or even other fashion brands dealing with. So that diversification was key, and thankfully we did that ahead of the pandemic.
I am curious. I mean, you've been around long enough, Kendra, at least with this business, to kind of see different business cycles. And I mean, who knows what's going to come tomorrow, but there's obviously a lot of talk about softness in the economy, maybe even the potential for a recession. How does a jewelry business hold up if you have the consumer maybe backed into a corner?
You know, Romaine, I love to tell this story because my company went through lightning in a bottle growth during the recession, the 2008 recession. And it really was one of those times where we realized that us making this direct connection to our consumer, which we had, and this attainable price point, this value that she wanted, really helped us accelerate. So we actually grew double-digit growth in 2020 to 2021 during, again, a really uncertain time within our economy. And I think that's really important for, you know, businesses out there to understand is that you've got to really, you know, meet your customers, one, where they're at. You can never be complacent. I think for us, we always put connection before transaction. During the pandemic, we were reaching out to our customers, whether that was via phone or FaceTime, to try to still service her. And we're always being creative with how we're going to connect with her.
I am curious, too, about the journey that this company has been on. It's pretty rare to have a company start up in a space that is already dominated by big players like Signet and others and actually gain a foothold. The only example I could think of is actually in the sports apparel, where Under Armour kind of came out of nowhere and basically challenged Nike and Adidas in a way that I don't think anyone has. Is there sort of a pathway, I think, for, I guess, the next Kendra Scotts, if you will, whether it's in jewelry or in other areas, where they can also sort of go up against the big guns in this industry and find their own footing?
You know, I think it's really important for anybody, right, whether it's jewelry or any industry, that you are, filling a white place in the market. For me, when I started out, there was fashion jewelry and there was bridge jewelry. And there really wasn't anything in between those two categories that gave customers the quality they wanted, but that they could still afford and figure out how to purchase. And so we kind of carved this path within the jewelry industry that was a very unique space. I think when you're looking at anything out there, right, what you're going to do, you've got to fill that white space. Second, you have to be disruptive. We have all of our own unique shapes. We create our own unique colors and stones and materials that we use are very identifiable to our brand. And that was something that no other jewelry company was doing or can do in this price point, or that I've seen do, I guess, in this price point. So I think both of those elements are extremely important if you want to be successful in business today.
And Kendra, we only have about 30 seconds left with you, but I'm curious about how people are buying jewelry. What divide do you see right now between brick and mortar shopping versus people buying online?
So about 50% of our business is in our retail stores. We actually are opening 9 retail stores this year, which is really exciting. A lot of people were saying, oh, it's the end of brick and mortar, but that is totally not true at Kendra Scott. For us, it's an experience. Our customer comes in because they're craving human connection. And that's something that we're seeing more and more of, especially post-pandemic. Those customers want to be able to be there with their friends, have experiences. 30% is still shopping on e-commerce. Some of them are coming for curbside delivery just to see their favorite folks at our stores. But regardless, again, we're meeting her where she is. And then 15% of our customers are shopping with other retailers in our wholesale division of our company. But we really see that our customers, they want that connection with each other and with our Kendra Scott family.
All right, Kendra, going to have to leave it there. Great to catch up with you. Great conversation. Kendra Scott, of course, she's the founder, executive chairwoman, and lead designer, of course, of her namesake company, Kendra Scott. Katie, you're very familiar with her, and I think the world has become familiar with her. I'm just fascinated by how fast this business got built, and obviously she's already seen some challenging times, as she mentioned, with the global financial crisis, and who knows where we're headed next.
I know. It's a really interesting history there, and I think that's a great point that you made. It's not often that you see an upstart really challenge some of the incumbents in a successful way.
Yeah, absolutely here. A lot more coverage coming up here on Bloomberg. Going to talk a little bit about Disney and their parks, planning on doubling its park spending over the next 10 years. I thought they were pulling back on the parks.
Apparently not.
I don't know what's going on over there. We're going to find out after the break. Stick around. This is Bloomberg.
Well, Disney is nearly doubling its investment in parks and resorts over the next 10 years to $60 billion. And Romaine, we spent so much time talking about the streaming business, but Disney said that it's seen record growth in customer spending at parks over the past 2 years.
Yeah, it was interesting. When Iger took over, remember, there was a little bit of a scale back of some of the initiatives that Chapek had taken with the parks, like the Star Wars themed hotel and a few others. And it raised a lot of questions. Are they kind of scaling back there? Because I feel like this is just like the ultimate cash cow, right? I mean, people, it doesn't matter what they charge. People pony up, they go here, spend thousands of dollars to stand in line.
Yeah, I mean, going to Disney as a child in America.
This is the emptiest you'll ever see this park. This must have been taken at like 3 in the morning or something.
Right, in 2020.
Right.
But yeah, it's like a rite of passage as an American child that you go to Disney.
Yeah.
And of course, it's a significant part of their revenue. So a nice reminder to think about parks when you think about
What percentage of revenue do you think parks is?
We just looked this up, 33%. This is Bloomberg.
This is the countdown to the close. About 30 minutes until we get to those closing bells, and about 22 and a half hours, Katie, until we get to that Fed decision.
And in anticipation, you have the S&P 500 lower right now by about 0.3%. So a pretty muted loss all told, which means it's a little bit surprising that you have nearly every sector in the red right now.
What's going on with healthcare?
I don't know. It's really fighting to stay green right now, flipping in and back and forth. We'll call that unchanged. You go down the list, though, you have communication services, technology down slightly. You go all the way down, industrials consumer discretionary, and energy, off by more than 1%. This time yesterday, I believe it was the biggest gainer on the day, but currently the tables have flipped, biggest loser on the day.
Yeah, let's check in on some of the individual movers here. I actually start at the bottom here with Elf Beauty, down about 8%. In fact, it's on an 8-day slide here, longest daily losing streak for the company going back to early 2020. I reached out to Bloomberg Intelligence analysts to ask what this was all about. They said there's no real fundamental news here, but we've been seeing a lot of softness in that space. Keep an eye on names like Coty and Ulta Beauty, also seeing some softness there as well. Meanwhile, SIBO actually rallying today, this on the back of losing CEO Ed Tilly being pushed out here because of his failure to disclose some personal relationships that he had with employees. They've named a new CEO in the interim. Shares moving a little bit higher on the back of that here. And let's check in with ARM Holdings on a day where we get a new IPO in Instacart, which we're going to talk about just a bit. ARM down now for a third straight day here, down 5%, and at $55 is actually below that opening price that it had on the day it came to market, which I think was around $56.10 here. So not quite the best signal here for the secondary trading that we're seeing in that name. And a wild story on Microsoft here. Apparently the company uploaded a bunch of files to a federal court. This has to do with the case that it's part of now. It was a mistake, but what we learned in that report was, well, a lot of company secrets that I don't think they wanted to get out, including plans for a new Xbox refresh at the end of 2024. And we learned in that same leak that the company actually looked into buying Nintendo back in 2020. Ultimately, it passed, and of course, it then a couple years later made a big bid for Activision Blizzard, which is still struggling to close. Meanwhile, there's been a lot of activity in the oil market here and a lot of concerns right now about whether we could see oil prices continue to move higher. A bit of a reprieve here on this day, but when you look at the time spreads here, you're still seeing WTI as well as Brent crude in backwardation. That's a signal that, yes, supply is tight, and if supply is tight, particularly in this demand environment, that could potentially mean, Katie, that prices could go higher.
Well, let's turn back to Instacart, which, of course, you mentioned, Romaine. It's our stock of the hour. And, of course, Instacart, it made its market debut earlier today. And our own Katie Roof has been all over this story. And, Katie, you take a look at Instacart shares. We got as high as 43% higher. You take a look at trading right now, Instacart still up 15%, but it looks like some of that initial enthusiasm is starting to fade a little bit.
Sure, yeah. They had a very big pop. Now it's a more modest pop. But, you know, they priced at the top of the range, and that range had been revised above from where it had been before. So, you know, they're doing better than they initially hoped. You know, much ado has been made about how in 2021 they were valued at $39 billion, and where they're trading now, maybe it's $12 billion, $13 billion, depending on whether you use the fully diluted market cap or not. But they knew that they had gone down in value. They knew where the market was, and they lowered their own internal valuation to $13 billion last year. So it's about in line with that.
So give us a sense here, Kate. There's been a lot of talk. I mean, at least for people who want to sort of assess what the longer-term future of this company is, there's been a lot of talk about the data that they collect and how they've leveraged that into effectively having this side business, if you will, as an advertising company. That's something that some folks seem to think could become their primary business.
Yeah, I mean, obviously the data they have is really valuable for advertisers, particularly those in the food space. They know a lot about what their customers like to purchase. And so they've been able to grow their revenue streams beyond just their core delivery model. And that's also helped them turn a profit.
So there's been a lot of talk as to whether this means that sentiment in the market has shifted, Katie, whether there's going to be an opening now for other companies to sort of rush through the door and bring their companies to market here. Obviously, Katie has been, Katie Greifeld, the other Katie, excuse me, has been talking all day long about Birkenstock. And of course, there's another company that I'm told is supposed to price potentially this week.
Yeah, so Klaviyo is a tech company out of Boston. They do marketing tech, and they're pricing officially after the bell today to go public tomorrow. And they're actually about the same size as Instacart. I mean, you know, we're expecting a $10 billion company or more. And they get a little less attention, though, because they're not consumer facing, but certainly this will be a big win for the early venture capitalists in this one.
And so it's interesting, if you look at ARM, if you look at Instacart, both of those companies actually lined up big investors heading into the listing to support that listing. Is that the new playbook here, to kind of try to stack the deck as much as you can?
It does seem like there's a pattern here. I mean, obviously, all three of these companies are in distinct categories within tech, but they all are profitable and they all lined up big anchor investors. So, and they're all working with Goldman Sachs. So it seems to be that there was some sort of strategy that they're looking to make sure that these companies, have a safe debut, because the last thing the bankers need, the last thing the tech industry needs is for the window to close again. I mean, there haven't been any big tech IPOs since late 2021. So everyone who's in this space is rooting for these companies.
Well, that's the thing. Of course, there's a lot of optimism that maybe this is the sea change where you start to see some of those companies waiting in the pipeline actually come to market. But put this year up to this point into context for us. Just how dry has the IPO market been?
I mean, you see a lot of companies, a lot of tech stocks down 70, 80, 90%. And so that has really scared a lot of tech companies from going public. So, I mean, this year, there have literally been no big tech companies up until now. There were none last year braving the IPO window. I mean, there have been a few smaller SPACs, but investors have really soured on that as well. So, I mean, this is the moment where they're trying to open the window.
All right, Katie, great reporting as always. Know you've been a busy woman. Our thanks to Bloomberg's Katie Roof. From New York, this is Bloomberg.
Welcome back to The Close. It's time now for our Options Insight segment. And we want to get you up to speed with the day's options trading with Abigail Doolittle, who's standing by with a look at the equal-weighted S&P 500 and why it could be a worry for stock bulls.
It's interesting, Romaine, because this year we do have the equal-weighted S&P 500 up 3 to 4%. The regular S&P 500, including those big mega-cap tech stocks such as Apple, Microsoft, Tesla, and so on, up 15%. The question is there a catch-up trade, or is the equal-weighted index signaling something to big cap? To talk more about this, let's bring in Mark Newton, head of technical analysis at Fundstrat. Great to have you with us back again, Mark. And a lot of people, I love catch-up trades. When you see that difference between whatever, like the two markets that you're comparing, often it does create a nice catch-up trade to the upside. However, it can also be to the downside. Which way do you see this going? Because that spread at some point should narrow.
Thank you. Yeah, I think eventually we ought to see technology start to deteriorate. We haven't seen that yet. The issue is that we've seen pretty rampant underperformance in groups like discretionary, industrials. Most of the consumer sector has been under tremendous pressure in recent months. So you can look at this two ways, as you mentioned. One is that the equal-weighted has underperformed the regular S&P. That also means that tech has dramatically outperformed. So that outperformance of technology has caused the equal-weighted index to actually underperform. My thinking is it's going to be difficult to make money in groups like financials, I think, with an inverted yield curve, and my analysis says that should be under pressure. But, discretionary clearly looks to be an underperforming sector. There are areas that I want to overweight, like industrials. I do like technology, but I feel like the consumer area should be avoided. So I don't know if there's any clear-cut conclusion saying that tech has to roll over, or that the other equal-weighted has to rally. Right now, it's just something to be aware of that, look, the last time this happened was really back in 2021 when equal-weighted indices fell substantially, and we were waiting, and tech held the market, and it really camouflaged the entire rally until the market fell.
Well, I'm guessing that tomorrow's Fed meeting and the one in November could be crucial, because a lot of it having to do with rates, and if the right. Fed is to indicate, or they do actually raise rates again, that could, of course, take money out of the system and pressure technology. And if you think discretionary is under pressure, it's kind of interesting, because on the year, it's one of the top sectors at more than 30%. So we could really see something. Volatility, so we're starting to see it. I feel like we're starting to see it creep back into the markets. That's measured by the VVIX, which is relatively high. But you make a really interesting point that just over the last few weeks, the VIX is starting to creep higher relative to the VVIX. Right. Does that mean that we are going to see a big spike in vol finally?
I think that's right over the next 1 or 2 months. I think it doesn't necessarily have to happen in October. A lot of my cycle work says November is actually a key month. But whenever you see the spot VIX start to elevate versus the VVIX, the VIX of the VIX, oftentimes that brings about volatility. And it's very difficult to analyze the VIX technically, as people know. But looking at that ratio between VIX to VVIX, that gives you very clean signals oftentimes on breakouts or breakdowns. And it broke out actually in late July out of a multi-month downtrend. So my thinking is the VIX will in fact go higher. We're ahead of this crucial time ahead of the Fed. The VIX was up near 18.5 last month. Now it's down at 14.5. So I think it makes great sense from a risk-reward standpoint.
So you mentioned July, and that, of course, reminds me of when the dollar started to break down and then quickly reverse higher, which has put so much pressure on a variety of asset classes. One asset class that has not put pressure on, though, it's so interesting, is oil. Oil is just screaming higher. This stealth rally up 25, 35, I think 35% actually, since its low earlier this year. Chart-wise, though, it looks like it may not last. Where do you weigh in here?
I agree that in the short run, it's gotten overdone. I'm very bullish intermediate term on crude over the next 12 months. I think near term, though, it's not going to get above 100. That's everybody's thinking. Oil has to get above 100. I don't think that's true. It has gotten a little bit overdone. I see evidence of market exhaustion. There's huge backwardation now where, 1 year, spreads in crude is almost like 11 points lower on the back end. So I'm seeing evidence of exhaustion where I think it's going to dip down to the low 80s and probably eventually entering this seasonally tough time for crude. It might actually get to the 70s, but that would be honestly a very good time to buy. So intermediate term, I do see crude heading back up well above 100. I don't think it's going to be this year.
And how do you play that through options and tie the dollar into this?
Yeah, I just would look at simply just taking, for example, December crude futures, that expire actually in mid-November. I would look to buy puts on the 90. The 90 strike, and you can buy those right around $4 right now. So I think that makes a lot of sense. I think crude will pull back to the low 80s potentially over the next month, and so that would make great sense just from a traditional, not based on vol necessarily, but just based on directionally and where I think crude is going to go.
So maybe an opportunity for the bears on oil over the next month and a half, and then maybe a nice opportunity for the longs thereafter, and it's going to be interesting to see how the dollar plays into it.
That's correct.
Mark Newton of Fundstrat, thank you so much for joining us for Options Insight today. We really love your analysis, as always.
Thanks, Evan.
From New York, this is Bloomberg.
This is the countdown to the close. Romaine Bostick here, joined right now by Scarlet Fu. She joins us, of course, every day at this time to help take us to the bell and beyond here on the eve of a big Fed decision.
Yeah, and this is a Fed that's expected to remain on hold, so it's kind of surprising how big the sell-off is in bonds. And at one point, the S&P 500 down 0.8%. Some pretty big moves for what's going to be a pretty lackluster Fed decision.
Well, that decision is going to be lackluster, but I think everyone's so focused on this idea. Are we going to get something telegraphed out of the Fed, either in those economic projections or in what Jay Powell says that suggests that there might be more hikes to come?
Exactly. What's to come is the big question here. And of course, we're looking at a two-year yield now above 5.10%. Is the next stop 5.11%, which is what we saw in early July? That's a big question. Dollar not doing very much, but oil's move higher is a reminder once again of the vigilance that Powell and the Fed need to keep inflation from reigniting.
Yeah, of course, a pocket of the market, the economy, I should say, that he makes clear that Fed policy itself cannot move.
Yeah, and of course, there's a lot of excitement over the newest IPO, right? Instacart, rising as much as 43% on its trading debut. It's pulled back quite a bit, but certainly that's something that people in the markets want to see to get those animal spirits going. And Pinterest. I know that we always talk about Pinterest and, we're not quite sure who uses it. Teenage girls use it. That company reiterating third quarter revenue growth in the high single digits.
All right, let's get to our next guest here as we count you down to the close. Jurrien joining us, Fidelity Investments Director of Global Macro here. And Jurrien, I guess let's start with the macro. And I think what's on everyone's mind right now is, are the global central banks, whether we're talking about the Fed, the ECB, and I guess some of the other far-flung ones there, are they really at the end of this rate tightening cycle?
I think they are. Whether the Fed goes another 25 later this year, I mean, obviously no one's expecting them to move tomorrow. So I do think we're getting close to the end, but I think the big question rightfully in the market is, how long is it going to stay at these levels, right? The market has been incorrectly anticipating a pivot happening imminently, really for the last year plus. And at first it was down to, 3 and even below. Now it's down to the high 3s. But I think the Fed has been correctly signaling that they're going to be higher for longer. Inflation is coming down, but it's not down to the levels where the Fed would like it to be, and the base effects are in the rearview mirror, right? We saw the CPI actually ticked higher last month, and the core PCE remains at 4.2%, which is twice the Fed's target. So I think the Fed, what we're all going to be looking at with the FOMC meeting is that dot plot, how quickly are they going to revert back to a neutral rate, and what is even the neutral rate, these days anyway? Is it 3? Is it 4? Is it 5? And that's been a big question nagging the market as well.
Yeah, nagging the market. I mean, I guess it's kind of pick your own adventure here, Jurrien. I mean, these sort of market cycles well, and you have a market, of course, looking for some clarity out of a Fed that probably isn't going to give them that clarity. And one thing I love about you, Jurrien, you put out these notes every week, these kind of a look at the week ahead, if you will. And your latest one sort of references an old movie that a great movie, I should point out, that old Darren Aronofsky movie called Pi, coming up against the 25th anniversary of the release of that. And what's so great about that movie, this was really about one person really trying to make sense of the world, basically trying to place order on a world of chaos. And I kind of feel like we're seeing the same thing right now play out in the market when it comes to trying to divine the next moves of central banks.
Yes, and by the way, that was a great movie. And actually, I saw the 25th year anniversary re-release on IMAX on Pi Day in March. So just a piece of trivia there. But he was trying to solve the market puzzle. And of course, some puzzles are not meant to be or able to be solved. But, when we think about investing is making real-time decisions with imperfect information. This is why investing, at least over short horizons, is so tricky, because the market's always anticipating the future, not always correctly, of course. Markets are very efficient in absorbing information and discounting it, but there are still a number of assumptions out there, right? So one of them is, how do we know our star is really 1%, which is what the Fed model says, because our star is not an observable actual market rate. And then I think the bigger question is, inflation is at 3.5%, 4%, depending on which headline measure you look at. The TIPS market, on the other hand, seems to be convinced that inflation is going to drop to 2% imminently and stay there basically for the next 30 years, right? If you dissect the TIPS forward market from 1 year to 30 year, it's at 2 to 2.5% during that entire term structure. And hopefully the TIPS market is correct. I mean, wouldn't that be great? And I think the TIPS market is betting on, don't fight the Fed. If the Fed wants 2 to 2.5, the Fed's going to get it one way or the other. But it's all assumptions, and that's why this is such a difficult puzzle to solve.
Right, and those are market measures. I'm curious, when you say imperfect information, data points provide a lot of that information. So are there any hard economic data points that you see as less reliable and maybe require some reassessment, some reinterpretation?
It's not that they're not reliable. It's just that the market moves so quickly to discount the information that, the market. So we know that over the long term, stock prices follow earnings. But over the short term, the market discounts the future, right? And this is why at cyclical inflection points, the market's always 2 to 3 quarters ahead, which is why during early cycle bull markets, like presumably what we've had over the past 11 months or so, the market will move up even though fundamentals are still kind of weakening. Earnings growth has been slightly negative, because the market's looking ahead. And so it's not a question of whether the data points are correct, but it's just how much the market has already anticipated them and how much of that is priced in. And so right now, a soft landing is priced in. And so, we better get it then.
Okay. Well, how are you thinking about the U.S. dollar's recent strength, Jurrien? Is it a driver of stock prices and other risk assets, or is it the outcome of moves into safe havens like treasuries or other similar assets? Is there any causation at work here, I guess?
I think it's the latter. I mean, the dollar is driven by many things, capital flows, sentiment, but one of the hallmarks of what drives currencies is, of course, interest rate differentials, right? And so what we saw during the pandemic is that all countries eased policy. They did QE. We had negative real rates. And the Fed has been leading the charge in reversing that policy. The ECB close behind, but Japan, of course, still in the other direction with its interest rate control, and China also in the other direction. So when you look at the dollar, it really depends on which cross currency you're comparing it to. But against the euro, it's been kind of even-handed, even though the euro did fall to 106 last week when the ECB raised rates. But it's against the yen and the yuan where the dollar has been the strongest. And I think we can just point to the divergences in monetary policy to see why.
All right, Jurrien, going to have to leave it there. Always great to catch up with you. Great insights as always. Jurrien Timmer there over at Fidelity, head of global macro here on what could potentially be, Scarlet, a big macro day tomorrow. That Fed decision at 2 p.m. Washington time. We'll have full coverage then. In the meantime, stick with us as we move closer to the closing bells here on this Tuesday afternoon. Our full market coverage right here on Bloomberg starts as we take you to the bell and beyond.
Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlet Fu. We're counting you down to the closing bell. We're here to help take us beyond the bell. It's a global simulcast with our friend Tim Stenovic. Welcome to our audiences across our Bloomberg platforms, television, radio, as well as those folks streaming on YouTube.
Carol's here too, I promise. She's here.
I hear like the
Jay,
disembodied voice of somebody, but
there she is.
Wait, she gets her own box. Wow. Wow.
Really
the star of the show.
She was not stuck on New Jersey Transit. She was not at the American Dream Mall.
Well, I was solving climate change over at the Plaza with the Earthshot Prize and Bloomberg Philanthropies. You guys, what'd you do to the Treasury market here, guys?
Yeah, blame it on Romaine.
I am going to blame it. Look at the 10-year.
This is, but this is that reassessment I think a lot of people are making right now about just how much further rates have to go. Remember, this isn't just about the Fed anymore. This goes beyond monetary policy. It's about economic conditions.
Well, we just had a guest on too, right, who says, wait, you look at what the 10-year yields and you look at what the S&P 500 with a yield of about 1.5%. Like, you start to say, wait a minute, it makes increasingly more sense, Tim, to put money in the Treasury trade.
Yeah, and look, that was Charles Tan, the co-CIO over of Global Fixed Income at American Century Investments, Scarlet. But I have to tell you, there's also been a change in tone that I've noticed over the past couple of weeks, and especially today. Team Soft Landing has really seemed to be winning this, but this new note from Anna Wong over at Bloomberg Economics, there's a lot of pessimism out there right now.
Well, can I just on that point though? They also put out a note, her and one of her deputies, saying that the last 4 recessions have all been preceded by this drumbeat of soft landing.
That's what I'm saying.
Yeah, you saw the same thing.
Territory.
Yeah, interesting report. If you have a Bloomberg terminal, I definitely urge you to check it out. The data that they put, kind of sobering here, given how much we talk about, we might actually be out of the woods.
We're all inclined to believe that a soft landing is in the cards.
Yeah, absolutely here. On this Tuesday afternoon, market's still in a bit of a holding pattern. Fractional losses across the board, with the Dow down about 0.3%. The S&P and the NASDAQ each down about 0.2%, while the Russell 2000 is going to finish the day lower. Carol Masser, if you are actually there, down 0.4.
I'm still hurting from that 3 box.
Yeah.
I'm just going to say, I'm a sensitive little gal. Hey, S&P 500, by the way, about 199 names to the upside, guys, 302 to the downside. So we definitely are seeing more of a negative tone, but, we're all kind of waiting for the Fed decision tomorrow.
Yeah, the negative tone is really reflected in the sector performances, too. If you pull up the 24 industry groups of the S&P 500, let's start on the decliners. Retailers off by 1.25%. You've got chip companies losing about 0.9%. Energy stocks down 0.8%, even though oil prices remain somewhat high at new 15-month highs. Keep in mind, energy was the best performer over the last 3 months. On the upside, those that are bucking the decline, insurance companies, autos, and tech hardware are each up by at least 0.5%.
All right, interesting. All right, so that's your big look at the markets, the big major industry groups. Enphase Energy, let's get to some of the individual gainers. It's number 1 in the S&P 500 and the NASDAQ 100 today. It's up about 4.2%. After the close yesterday, news that company director Thurman Rogers reported a series of insider stock transactions. He reported that to the SEC. It's about $4 million worth. Stock, keep in mind, is down about 10% over the past month. It's down more than 50% year to date. 8% of the float is shorted, but nonetheless, news of that insider buying certainly sending that one as a top gainer in today's trade. Also want to go to the cruise lines. Both Royal Caribbean and Carnival getting some upgrades. Royal Carib upgraded to buy. Carnival lifted to hold at Truist Securities. They are citing strong trends and cooled off stocks. So you had Royal Caribbean up about 2.5% in today's trade. And Carnival was up 3.6% at its highs, but finishing with about a 1/3% gain. And this is for you, Romaine. Rackspace Technology.
Yeah,
it's a small cap, about $425 million.
I love small cap.
I know you do. About 36% higher in today's trade. Notable move. This is after Raymond James did an upgrade. It's an infrastructure software company, upgrading to outperform from market perform, saying its turnaround plan is gaining traction. Price target set to a street high of $3.50. Stock closing at about $2.
And we should just point out, too, of course, keeping an eye on Instacart. Those shares, at one point, up 43% on the day.
Oh, I missed that one.
Closing right
Thank
now.
you.
Did miss it, but that's okay. Up 12%.
That's what happens when you keep me out of the 4 box. I'm just telling you.
No Instacart.
Retribution.
Carol's got the gainers. I got the decliners. Let's take a look at what happened with Amazon today. Should note that higher bond yields hitting tech shares. We saw the mega caps all move lower today, many of them, Microsoft, NVIDIA, Alphabet. Amazon among the worst performers on a points basis, the worst performer in the S&P 500 on a points basis, finishing the day down by 1.6%. The company did say a little later in the session that it would hire 250,000 employees this holiday shopping season. It's going to boost average pay for those logistics personnel to about $20.50 an hour. The company is still dealing with attracting and retaining talent in this environment. Let's also take a look at shares of Walt Disney. Early this morning in a filing, shares have been down all day. It finished the day down 3.6%. Early this morning in a filing, the company coming out and saying that it's going to nearly double its investment in parks and resorts to $60 billion over the next 10 years. The company said it's seen increased profits from investing in these parks, cruises, ships, and other attractions tied to its movies and characters. Disney said it's seen record growth in customer spending at the parks over the past 2 years and a significant decrease in the number of tickets it sells at a discount compared with before the pandemic. It's also gotten pretty expensive to go to those parks.
Gotten pretty expensive?
Yeah,
it's been expensive for a long time.
Very expensive.
Well worth it. Had fun,
Here's
but
a small
man.
cap. Rocket Lab, finishing the day lower today by 7.5%. It's a small satellite launch company. Overnight, about 3 a.m. New York time, launched from New Zealand. A failed mission. It led to a loss of its primary Electron rocket and the payloads that it was carrying into orbit. Shares were down as much as 15% earlier in the session, finishing they down by 7.5%, Romaine.
Let's take a quick look at yields here, because that was where a great deal of the price action was here on this day. You saw the entire yield curve shifting a little bit higher on the day, with the biggest activity in the 5-year and the 10-year space, each up about 6 to 7 basis points. In fact, right now you have a 2-year yield at the highest level since 2006, a 5-year yield at the highest level since 2007, and a 10-year yield also at the highest level since 2007 here. So that's what the market is staring into, and that's what the Fed is going to have to stare back into as it makes a decision tomorrow about what to telegraph to this market. Does it give them some sense here that mission is accomplished, or at least on its way being accomplished, or do they try to jawbone the market into believing that the Fed might still hike again?
There's no indication that they're going to say mission accomplished. I think everyone's learned the downside of doing just that. But if the message is higher for longer, that's what they've been saying for a while now. Why today is that resonating in a different way?
I don't know. You know what I keep thinking about? These yields at 2007. 2007, 2008 was a very different environment. I'm not saying that there aren't stresses today, but it's like I'm trying to make sense of the comparison. They're not the same situation. So what is it kind of behind it? I just want to say to Scarlett to try to answer her question, though. But a lot of this is kind of sort of being disconnected from the Fed. That a lot of folks we're talking to are saying that when you look at we're looking at it from the yield perspective, but you have to kind of look at the flip side, which is the price perspective. And the idea that if economic conditions are deteriorating, like some people believe here, why would you want to hold 10-year duration or 20-year duration?
Right. You have no visibility into what's to come. And we know that inflation, the easy work's been done on inflation, right? The disinflation trend, most of it's been done at this point. It's going to be harder. The comparisons are a lot harder, too.
And some people would argue that it was no work at all, that a lot of sort of the downdraft in inflation had less to do with the Fed policy and more just to do with some of those, I guess, transitory issues that we all sort of laughed at.
So Powell's kind of right.
But there's a lot of things happening right now in the environment that Powell has no control over, and also indications that the labor market is still really strong. I was surprised to read in our write-up of the Amazon news with 250,000 employees being hired during the holiday shopping season. That's more than hired last year, more than hired back in 2019.
How much are they paying them, Tim?
$20.50 an hour.
Okay.
So, and it's still having trouble. The company's still having trouble attracting and retaining talent. So that's not indicating to me that there is a problem in the labor market to the extent that, that people are concerned about job losses. It's still hard to attract and retain talent in this environment.
Yeah, it's interesting. I keep having a lot of conversations with people who are like, I can't find enough workers. In the construction business and contracting, that is still a lot of stress points.
So that's kind of scary from an inflation perspective. I mean, the UAW is out there, making these demands for a 4-day work week and other demands too. Workers feel like they have power still.
I feel like I have power. I got my box back.
I mean, Carol, I mean, she just, I mean, like I said, she just works half a day.
She showed up halfway through the
If
show.
only everyone could just get a box,
I
and
mean,
that would
these
be
4 people on the
power.
screen, we know who has the real power here. It's, you know, Barbie there on the far end of the
Hey,
screen
listen, Barbie.
It's because of the Barbie pink. That's why.
You got pink there.
You know,
Don't get me in
Barbie's pretty
trouble.
powerful. Ken
I've done my
is the
BE
one who's not so powerful. I'm just going to say. All right,
I
guys.
feel sorry for Ken.
Do you really?
Not really.
I think he
Okay,
feels
I
sorry
didn't
for
think so.
himself, too.
All right, guys, that's a wrap. We're going to see you guys tomorrow, and we'll have a Fed decision, which will be really exciting. All right, that's our cross-platform coverage. Radio, TV, YouTube, Bloomberg Originals, Beyond the Bell, and Countdown to the Close. We'll see you tomorrow.
Stick with us. A lot more coverage coming up here on Bloomberg Television, including a conversation with the New York State Comptroller, Thomas DiNapoli, on the state's budget and other issues going on. That conversation coming up in a bit. This is Bloomberg. The net result of the trading today in U.S. equity markets was somewhat muted, but what happened in between from the start of the open at 9:30 to the close at 4 p.m. Eastern Time? It was certainly wild. A lot of volatility in equities, commodities, as well as in the Treasury space. And S&P 500, though, the net effect of that only down slightly on the day, and that was the story for the major indices. But you did see a lot of activity in the crude oil space, up about 1/10%. May not look like much, but at one point you had a WTI flirting with $94 a barrel. The dollar also all over the map today, and you had a 2-year, 5-year, and 10-year yield now hitting their highest levels once again since 06 and 07. As far as some of the individual stories out there, Disney shares took a big downdraft here on the day, down about 4%. A similar move lower for ARM on this third day of trading since the first day of trading when it had its IPO last week here. Now at 55.17, below where it opened on that first day of trading. So some softness there coming off the euphoria that we had the first day. Royal Caribbean and the rest of the cruise lines did get an upgrade earlier today, and you saw that reflected in the shares. And the automakers, Stellantis up 2%, Ford, GM. Most of the automakers still holding up as some of the concerns about the UAW strike, at least for right now, not translating into any concern about a hit on the company's fundamentals. Of course, the big focus, of course, will be the big Fed meeting, the big Fed decision, which will come at 2 p.m. tomorrow. And this is a good reminder of putting rates into perspective here. You're taking a look at the 10-year yield, not just the yield on an absolute basis, but the rate of change. We've sort of normalized this on an 18-month rolling basis here. And you have a big part of the reason why there's been so much agita in this market in the latest rate hiking cycle. This is the rate of change over 18 months here, and it was dramatic. That was what caused a lot of the ructions in the market. It's what caused a lot of the uncertainty when it came to the market trying to forecast economic conditions. Here's what we do know. Even if the Fed isn't done raising rates, it's unlikely we're going to see a repeat of that rate of change over the next 18-month cycle. That provides some degree of stability, a big part of the reason why you saw another IPO today, and maybe that provides the stability for a little bit of an opening when it comes to treasuries and the rest of the cross-asset space.
And of course, we'll continue to keep an eye on those moves, and we'll be checking in with Michael Pond a little bit later on for his take on what to expect from the Federal Reserve tomorrow. Meantime, it is a wild week here in New York City with the UN General Assembly and Climate Week events taking place. It is also the Earthshot Prize Innovation Summit, which is where New York State Comptroller, Thomas DiNapoli joins us from now. Thank you so much for speaking with us, Thomas. I really appreciate it. These are big gatherings. Yeah, they showcase the city of New York. They showcase New York State. I'm curious, from where you sit, what kind of economic impact do these kinds of big events have on the city and therefore the state's finances?
We love to host big events like this. It's great when you see the streets full. We hope people, once they get out of the meetings, are going to the restaurants and spending money, perhaps going to Broadway. So these kinds of events are very important, and certainly as the city continues to struggle with a recovery, it's just great to see the streets crowded. It's not easy to get around today, but you know what? That's like the old days, so that's a good thing.
Yeah. Struggle with the recovery. I want to follow up on that because in New York's last financial update, the state said that it's facing a $9.1 billion budget gap for next fiscal year. How are revenues and expenses trending at the moment? Do you expect that gap to widen, to narrow?
It's probably too soon to tell. It could go either way. You know, the challenge is we have updated budget projections. So where we sit right now, revenues are actually coming in ahead of current projections. But those projections were reduced in about a month ago when the financial plan was updated. So our revenues are down by about 13% compared to a year ago. So we seem to be on target, but with projections now that are lower. And that's why the out-year gap for next year is $9 billion, grows to $13 billion the year after that. So much depends on the health of the economy. Certainly in terms of personal income tax revenue, which is the biggest source of revenue for the state, we're seeing a bit of a drag there. So that's tied to the overall challenge of this economy that we're all living through right now.
Any sense as to how much of that drag when it comes to the personal income taxes is coming from Wall Street or the financial sector, I should say?
I mean, that's certainly part of it. We're seeing profitability on Wall Street really return to pre-pandemic levels. There was a big burst upward in terms of profits, in terms of bonuses, in terms of tax revenue. And really what happened earlier this year when the budget was completed, the end of April, beginning of May, then we got the final numbers in for the April 15 tax collections. And it certainly showed the securities industry was down from the year before. That's part of what drove those lower budget projections that we now have. Another piece of it is, we still have a net migration of taxpayers at the upper end out of the state. It's not quite the stampede that some of the critics say, but that's another concern right there. So we do have some trends that are somewhat working against us. We'll see how the street ends as we head to the end of the year. We'll see what the bonuses will be for next year.
What conversations have you had, whether here in New York City with the mayor or up there in Albany with the governor, with regards to that migration here? It may not be the stampede that is characterized in certain media outlets, but it's certainly significant. It's not just individuals. I mean, it's wholesale companies as well here. How do you maintain the competitive edge that New York City and New York State has had for so many years?
I mean, your question is absolutely a key challenge. Some of it has to do with tax policy, but I think as much, if not more, has to do with quality of life here in the city. We certainly know we've gone through a period where homelessness has been an issue, public safety has been an issue, mental health and not dealing with that has been an issue. And certainly in this year's budget, there were significant investments made, new investments, particularly in the area of mental health, to try to deal with that issue. Obviously, the mayor and the new police commissioner are very focused on public safety. But, we really need those quality of life issues to be addressed so that people, even if they might have to pay a little more, will still want to be here in New York City. And that is very much a challenge that we all need to be focused on.
I want to ask one question also on congestion pricing, because despite legal challenges, the city is moving forward with the congestion pricing plan. How imperative to the MTA is the revenue that's expected to be generated by this plan once it's put into place?
It's an important question because the MTA's capital plan is dependent upon congestion pricing. There are many critics to it, but I've often said if you don't want to have congestion pricing, what are you going to do to replace that revenue? Because it would throw the MTA's capital plan totally out of balance if we don't have it. So, we'll see what happens with the legal challenges. You do have the board that still has to deal with the question of what will the cost be? Will there be exemptions? If so, how many? How will it apply? But in terms of the MTA's finances, particularly with regard to the capital plan, congestion pricing is a key component of it. And we need that capital plan to make sure the system stays in good repair so that people will have a good experience going on a train or a subway or a bus.
All right, going to have to leave it there, Tom. Appreciate you taking time for us. Thomas DiNapoli is the New York State Comptroller there out at the Earthshot prize competition at the Plaza Hotel in Midtown Manhattan, just a few yards away from where he's sitting. The Treasury Secretary of the United States, Janet Yellen, is speaking. Let's see if we can dip in right now and hear what she has to say.
Between now and 2050. In the U.S., this means hundreds of billions in investment opportunities to enhance power generation and the electrical grid, retrofit buildings, and make advancements in agriculture, manufacturing, and transportation. Financial institutions have been taking note. They're monitoring shifting consumer preferences and new technologies. They're projecting how industries, from oil and gas to automotives to construction, will change in the future. In some jurisdictions, they're subject to policies and regulatory frameworks that require climate-related action. But across jurisdictions, they're responding to the demands of their investors and to their own business judgment and prudent risk management to consider climate-related factors. There's extensive evidence showing that the changing climate has significant financial impacts. Without considering these factors, financial institutions risk being left behind with stranded assets, outdated business models, and missed opportunities to invest in the growing clean energy economy. Many financial institutions, including some in the audience today, recognize the business case for action, and they have taken a key initial step. As part of initiatives like the Glasgow Financial Alliance for Net Zero, more than 650 institutions representing roughly 40% of global financial assets have made commitments to support the goal of net zero greenhouse gas emissions by 2050 or sooner. In the US, there is no requirement that these institutions make such commitments. Yet, more than 100 US financial institutions have voluntarily done so. Many of them have also developed plans to take these commitments forward and started reporting on their progress.
The Secretary of the U.S. Treasury, Janet Yellen, speaking in New York right now at a Climate Week event here in New York City, making the case here for the financial impact from climate change and why it needs to be addressed. You can type live, go into your Bloomberg terminal to continue hearing her comments here. And of course, we'll bring you any breaking news if it happens, when it happens. In the meantime, we do want to get back to one of the big stories of the day, and that was the investor appetite for IPOs. It appears to be growing following the successful debut of ARM last week and the debut of Instacart today. That conversation is coming up after the break. This is Bloomberg. All right, the newest ticker on the NASDAQ, CART, C-A-R-T, Instacart, selling shares to the public at $30, opening today at 42 and closing just around 32 bucks and change here. Caroline Hyde joining us right now, the co-host of Bloomberg Technology, to talk a little bit more about what is now the second biggest IPO, or second most successful IPO, I should say, that we've had in the last couple of weeks.
Yeah, not bad. One each week, and they both seem to be being popped at the open. I mean, this one was bigger than ARMS was. Once again, though, this is about cornerstone investors. This is about ensuring that you've basically sold off about 2/3 of the shares have already been placed with people that you know are going to be holding them, ensuring that the supply is curtailed. So the D1, who was actually an original VC back in 2020, they're now still a big key holder of this stock. Sequoia as well, still remaining into it. But this is a company that's managing to prove that there's a business model shift here. Simo, of course, Fiji Simo, who is the CEO there, really trying to captivate the audience with not just the way in which they built the advertising generation for the company, but also it's an artificial intelligence company. I spoke to her yesterday. Yeah, guess what it is? ARM, of course, was dining out on that particular hype, shall we say it. And really, I mean, my husband's busy using ChatGPT and OpenAI to be able to order off Instacart, and there are indeed ways in which you can already be using it.
He uses OpenAI to figure out what groceries you need? Does he not know what you like?
I mean, he gets the menu, then he puts in the order. I mean, but this is the way in which they're going to develop. So Fiji Simo was saying, look, we are at this real moment for artificial intelligence really benefiting this particular company. Maybe that's why some of the companies and retail investors were in it.
I have to stop by the grocery store after work, and I just wrote everything down on a piece of
there's
paper.
no AI involved there in Romaine's shopping.
That's far too old school.
Explain again specifically how Instacart is an AI play, because I'm still stuck on that idea.
Well, yeah, just the way in which you might think that automatically you'd be able to say, look, I have a family of 4, 2 are gluten intolerant, 1 is intolerant to, 1 is a vegetarian. Come up with a menu, then be able to put the order through. This is the vision that they have for the company. This is the sort of talent that they need working for them. This is where they're maybe going to be using the $660 million that they've just raised. But this is a business, I think, that she tries to say, look, the generative AI part of this is a big opportunity. She's not there yet, but eventually it will be. So that's perhaps one reason why people are excited about the stock. Maybe also just about, as I said, the supply-demand dynamics. And it's interesting, we've got Klaviyo coming up tomorrow.
Yeah.
They too have cornerstone investors, much more like the old school Fidelities of this world rather than PepsiCo, but still making sure that they're having a limited amount of supply and generating the demand. And maybe a little bit harder because it's B2B rather than B2C.
Is that an AI company as well?
Oh, you bet.
Yeah.
I'm waiting to hear how Birkenstock is going to be an AI.
Yes,
company.
I'm sure it is, right? You know, I'm sure there's got to be some sort of AI component there. In all seriousness, I only got a few seconds here. Is this kind of the opening, I guess, for some of these big tech IPOs?
Yeah.
I mean, the idea that ARM managed to get to market and do pretty well, and Instacart did pretty well as well.
And it's got to be remembered that the CFO of Instacart, Nick Giovanni, used to be head of TMT for Goldman Sachs. Goldman Sachs was helping with ARM. These are very well orchestrated deals because the bankers want the rest of them to do well. We've got Churro potentially coming up. We've got a whole list, 157, I think, NASDAQ. The key head of listings was telling me 157 companies waiting in the wings.
I remember when I was when I was a kid, I had a Spanish book. It was called Churros y Chocolate. That has nothing to do with anything here.
Not with car. That doesn't sound like a car sharing company.
No.
All right.
Not.
Caroline Hyde.
It was an AI book, Caroline.
Caroline Hyde joining us on Instacart's listing. This is Bloomberg.
Closing out a Tuesday afternoon, fractional losses for most of the major U.S. equity indices, fractional gains for the dollar, fractional gains as well here for WTI crude, which at one point on the day was flirting with about $94 a barrel. Of course, we are on the precipice of the next big Fed decision. Less a decision and more, I guess, guidance, if you will, here. Economic projections are expected out of the Fed, an update of that dot plot, and of course, anything that Jay Powell wants to try to communicate to the market. The big question is, will that market actually listen? Most of the activity that we saw in the cross-asset space today was in the yield space. A big jump in yields, particularly on the shorter end of the curve, with the 2-year, 5-year, and that 10-year moving higher. All three of those key points on the curve right now at their highest level, Scarlet, going back to 06 or 07.
Yeah, all predicated on that higher for longer outlook for rates. All right, let's talk about banks and their customers, because JPMorgan Chase has released its mid-year Business Leaders Outlook Survey, and it found optimism remains steady. 2/3 of small business leaders are confident in their company's performance over the next 12 months. 58% are positive about their industry's performance, and 47% are expecting a recession in the second half of this year. So for more on the survey, let's bring in Ben Walters, CEO of Chase Business Banking. Ben, great to see you.
Thanks for having me.
So in retrospect, I look at the survey results, and in some ways, it feels like the regional banking crisis of March, Silicon Valley Bank, First Republic, Signature going away, didn't really happen. Do you see any evidence of how that might have changed the psychology and behavior of small businesses?
Well, I think it brought the entire economic picture more to the fore. So we've always seen a gap in small business owners between how they say their business is doing and how they think the broader economy is doing. That's normal. You really have to be an optimist to be a small business owner, so I'll give them credit for that. But that gap's been wider than we typically see, and it's been wider since the mini crisis that we had back in March. So still today, 67% say my business is doing great. I think I'm going to grow next year. I'm really confident. But 47% think there's going to be a recession. That's the widest. That 20-point gap is really wide. Normally we see a 10 to 15-point gap. It's at 20. And I think that's because of all the noise you hear in the economy, and the mini crisis we had sort of zeroed business owners in on that and really got them focused on it.
Yeah, you really had to get your head around that. So inflation, obviously a huge challenge for these small business leaders. Single biggest challenge, in fact, followed by things like supply chain issues, retention of talent. One thing I noticed was not on there, taxes was on there, was high borrowing costs. Why isn't that up there?
High borrowing costs is sort of a feature of the broader economy that we're in, but it's not what small business owners think about in their day-to-day running of their business. So they are, of course, concerned with access to capital and the price of credit as they look to expand. But at the margin, this isn't what's driving their decisions. What's driving their decisions is, can I get more customers? Can I find the people that I need to run my business? Can I grow? Those things are first and foremost in their minds. When I make money, can I afford the tax bill when it comes? The financing costs is a problem they have once they have the growth opportunities in front of them. And so there still is plenty of capital out there for small businesses. Yes, we've seen some pullbacks in some regional banks and some pockets of the banking sector, but overall there's still ample access to credit. It's just a question of the price that they're going to pay.
We'll talk a little bit more about the labor component, because we've spoken with a lot of small business owners, mainly kind of weighted more towards the retail space, physical retail. And they've complained about this idea that yeah, they want to grow, they want to do all these great things, but they don't have enough people, or they don't have the people who are qualified enough to get them where they need to go.
It's a major problem,
Yeah.
and we've seen it be consistent. So whereas inflation has, although it is still the leading concern for small business owners, it's down significantly. That 30 is down from 45 last time. So we do see it moderating, whereas the ability to find good quality talent has stayed at that consistent level for the last few times we've done the survey. And we pulse every month, and it still stays high. We've seen that constraint come in. I've talked a lot about, if you look at who they're hiring, there's a lot less hiring from international folks coming in.
Yeah.
That's put a constraint on people. We've seen accelerated retirements, and small businesses get hit first. Right? Big businesses have different resources to bring people in that small businesses don't have. It's a huge concern.
Going through these survey numbers, the survey results here, are you finding, when you break it down and you see sort of the differences between certain industries within the small business space, is there a meaningful difference maybe in how one sort of pocket of the small business world is doing versus another?
Absolutely. We see it all the time, and we can see it in our own internal data. So in today's world, the closer you are to the end consumer, the more of a pinch you are feeling in general. That's not specific to hiring, that's more broadly. So think about, as these costs continue to go up, as wage costs continue to go up, as input costs continue to go up, we're sort of butting up against businesses' ability to put those prices through to the end consumer. If you're in professional services, if you're serving other businesses, there's still a little more leeway. You're still able to put those price increases through and maintain your margins. We are seeing more of a squeeze the closer you are to that end consumer. So if you're talking to retailers, it wouldn't surprise me that you're hearing that.
So when you hear that inflation is the single biggest challenge, what kind of solutions or tools can banks offer as a way to help these small businesses cope with this challenge?
What it's really about is managing cash flow. Ultimately, when your costs go up, you have to manage your cash flow that much more tightly. So the tools that we and other banks give you to manage your cash flow day to day, month to month, week to week become really important. Managing receivables is a huge deal, because if you think about many small businesses, they don't have the kind of resources to buy inventory 3, 4, 5 months in advance. They're buying as they go. So the more tools they have to manage that cash flow tightly, to know when it's going out and when it's coming in, that helps them maintain their flow through those tight times.
A lot of times when we have these conversations, at least on this program, there's always a lot of talk about how this is just kind of the business cycle, the economic cycle working its way through. But there are a lot of other folks that are seeing major structural changes in our economy, some of it because of the pandemic, but there are other things changing as well. As I'm sure you know, we're going into a rate environment that a certain generation has never seen. And that's going to have an outsized effect, I would think, in some of the decisions that these businesses make.
Yeah, it will. I mean, if you think back from the pandemic to now, there are certain things that all the pandemic did was accelerate. So we were going from a bricks economy to a clicks economy that had been happening over 20 years, but we got 5 years of transition happened in about a 6-month period. There are other things in terms of work from home. There was increasing work from home in the economy that got accelerated by 5 years in one go. But there are other things that do feel more structural. The way that people approach work, the way that people approach consumption, the way that they approach experiences. Those things did take a market shift that seemed more structural. In terms of interest rates, and obviously I know everyone's waiting for a Fed decision, I do want to temper that down a little bit. There's a whole generation that's never seen these rates, but these aren't the rates of the 70s and 80s. My parents bought their first house for 14% interest only. This is a different world. And I know 6 or 7% feels awful when you've been paying 2%, but it's pretty good relative to the hyperinflation days of the 70s.
Yeah, if you want to get an older person riled up these days, just talk about how high interest rates are at 4 or 5%.
That's right, it's all relative.
And they'll all have stories for you about how lucky we are today. Ben, great to catch up with you. Ben Walter, the CEO of Chase Business Banking, here in Studio 2 at our Bloomberg World headquarters. We want to go just a few blocks away in Midtown Manhattan, back to the Plaza Hotel, where Francine Lacqua is sitting down right now with Ursula von der Leyen, the European Commission President. Let's listen in.
This is very technical, so to share this expertise, we built up our green bond market, so to share everything which is necessary for it. Of course, to invest also at the beginning that this green bond market can be built up, and then get supply and demand at the same time started. This is why we are so important as anchor investor.
Where do you see it first? So how much and how quickly can that scale up, you think?
Depends on the speed that we are developing, but we've seen in our own green bond market, it was a steep rise immediately of the demand is out there. There's a lot of capital out there that is looking for the good projects. So we've seen it with the own green bond market. It really went like this, oversubscribed enormously. Therefore, the idea was born. to do the same for the low and middle income countries. And as I said, the resources they have them in abundance. They need the infrastructure, and therefore there's a lot of good capital out there that is looking for the reliable projects, and therefore it's a perfect match.
You've been, President, very vocal on carbon pricing.
Yeah.
Why?
That's the third point, where carbon pricing. In the European Union, we have made a very good experience with the topic of carbon pricing. What is the principle? It is a price on carbon. So we say, you want to pollute, you pay a price on the carbon you're emitting. You want to avoid it, the best thing is innovate into a clean technology. And that's what happened in the European Union. I give you a few figures. We introduced carbon pricing in the industry in 2005. Yeah. Since then, the economy has grown by 65%, while the greenhouse gas emissions have decreased in the sectors that were covered by carbon pricing by 35%. So an increase, a growth in the economy, a decrease in greenhouse gas emissions, and we got 152 billion in revenues from the carbon price, which we could immediately reinvest in the green transition. So it's an extremely effective and efficient tool. It's market-driven. It nudges the entrepreneurs into innovation. Couldn't be better. Now, if you look at the global overall scenery, only 23% of greenhouse gas emissions are covered by carbon pricing. So just imagine if we were able to increase that to 60%, the amount of revenues that would come back, besides the effect that it cuts greenhouse gases and grows innovation, the amount of revenues we could get back, if we agree to give a big chunk of that to the low and middle income countries, this is fresh money that has this triple effect: innovation, cutting greenhouse gas emissions, and investment capital.
President, on that, were you surprised at the speed at which this was adopted, or actually the scale of revenue? Like how big it became?
Well, it is now. I said at the beginning we covered industry. By now, we just started to cover road traffic and buildings. Mm-hmm. So almost the whole economy is covered by carbon pricing. We've made our initial learning experience, so we know how to move forward. And interestingly, there's a lot of demand out there. For example, China is building a carbon pricing system. We call it emission trading system. And they ask us for advice. How can we do that? This is good news. Because, of course, big emitters like China, for example, if they start with that, this is absolutely the right way to go. And we have different regions in the world where we have the carbon pricing already, but as I said, only 23% of the overall CO2 emissions are covered, so we need much more.
Is there a role for carbon credits?
Yes, absolutely, yes. Carbon credits have the advantage that if companies want to invest in green or sustainable products, it is possible through carbon credits. What is important is, and we could do this at COP28, that we develop a framework that defines what is a trusted carbon credit. So, and this is necessary, but it's doable, and I think it's also a perfect instrument for voluntary investment, for example, in sustainable projects.
President, what's the question you get the most by investors that want to put capital to work, but are either worried about greenwashing or getting it quite right?
Very important is that in politics, we're very clear with the direction of travel. It made a huge difference when I introduced in 2019 the European Green Deal with the climate law, where all 27 member states of the European Union accepted and agreed that we have the climate law with by 2030 and by 2050 goals, because this gave predictability and certainty to the private sector and the business community. Last week, I baptized the first container ship with green methanol. And the ship owner told me that when he started to think about planning such a container ship with green methanol, it was a bad business case. But he wanted to contribute to something good, so he wanted to do this innovative stuff. And then we came with a European Green Deal and with the climate law. And from then on, he said, immediately it flipped into a frontline project, a first mover advantage for him. And this taught me again, it's so important that politics is very clear with the laws that we give or the frameworks that we give. This is the direction of travel so that there's trust in the business community. They can rely on what the direction of travel that we are choosing together. And the investment then is there.
But President, do you ever doubt when there's a country that either is less ambitious on net zero or wobbles a little with their commitment, do you ever doubt that the transition will take longer than you thought 6 months ago?
Well, at the moment being, if we look at the world, or we're speaking about Europe?
Europe and the
kind.
world.
Okay, now if you look at the world, we are off track, without any question. But I'm deeply convinced and I'm confident that we can accelerate and we can be better. So it's just a question of, that we join forces and that we move on rapidly. And I heard the introductory remarks of Mike. He was describing rightly so the effects of climate change that we are already feeling. So it's very clear that we have to work against it. And we can do it. We can do it through innovation. There are a lot of good examples, what we've done already and where we have to go to. We have to convince the countries, of course, those who are hesitant, let's put it that way. What is important? I think we have been able to prove in the European Union that the transition to a circular, clean economy is our new growth strategy. And the United States did the same with the Inflation Reduction Act, for example. So a very clear message. The next generation of advanced products are the clean technologies, is clean energy, for example. And the race is on. Now the whole world is engaging. And the question is, who's going to be the first? Who is going to be the frontline countries or developer? Who is going to be the first mover? And of course, we want to be it, but competition is always good. So it shows that you can grow, you can be successful, you can be prosperous.
The president of the European Commission, Ursula von der Leyen, speaking right now with the very own Francine Lacqua over at the Plaza Hotel here in New York City. Climate Week here in New York on the back of those UN General Assembly meetings. Stick with us, a lot more coverage coming up, including setting you up for what's going to be a big day tomorrow, a big Fed decision, and more importantly, big Fed projections. Michael Pond, head of global inflation strategy at Barclays, is coming up after the break. This is Bloomberg.
All right, investors clearly eagerly awaiting tomorrow's Fed decision, Romaine, and of course, we will be all over it with the Fed special beginning at 2 p.m. and Jay Powell taking the stage at 2:30. It's not about the decision per se.
Yeah, not about the decision. Actually, beginning at 1:30. We don't want to shortchange our surveillance.
Oh, right. No, there's a big lead up. You're
we're
right.
at 1:30. Of course, the decision at 2, the press conference, and then we'll pick up the mantle from the surveillance team. But we know it's not about rates, right? I mean, there's no change in rates, at least nothing they've telegraphed.
It's going to be a hawkish pause.
A hawkish pause. The big question is that permanent, Scarlet?
Nobody knows. It'll depend on what we see from the dots, right? Where what they project for the rest of the year and for 2024. And that's the big question, especially as this soft landing idea really gains currency as not the default, but increasingly as the consensus scenario.
Yeah, but it's interesting, too. There's some great reporting on the Bloomberg terminal about the price action we've been seeing in the Treasury market, as well as in the options market, which seems to suggest a little bit more pessimism. I think that was part of the reason why you saw the big spike in yields, I think you mentioned earlier, particularly in the 10-year and some of those longer durations, that people are now worried about economic conditions, saying that even if the Fed pauses, if they're not cutting and the economy starts to soften a little bit, do you really want to extend duration at this time?
Right. What's the cost of all of that to stay higher for longer, even though that Jay Powell's been saying higher for longer for as long as I can remember at this point?
The other thing I thought was interesting, too, was the folks over at Bloomberg Economics, Anna Wong and her team, put out an interesting report where they basically said that the last 4 times that we had this much chatter about soft landings, we ended up going into a recession.
It's a pretty clear indication that a recession is around the corner. I mean, you know, once everyone gets on board with the idea that all is clear, and we've talked to a number of people who said the Fed is increasingly feeling more comfortable with the idea of a soft landing, too. They think that they're going to be able to pull it off. And maybe that's when everyone gets surprised with a recession.
The thing is, I mean, I think someone's made a comment a little bit earlier in this program about the idea that the easy part was done. I kind of feel like, to a certain extent, they're kind of in a good position right now, the Fed, right? The economy is still holding on, right? It may not be as strong as it was. It's withstood 5.25 points of rate hikes here. So even if they do something more incremental, I don't think they have to worry about the economy just sort of falling off a cliff, do they?
I don't know. I mean, everyone asks, the Fed usually stops when it breaks something. Has it broken anything? For a while, it looked like it was breaking the regional banks, but that, you know, they've continued to move on, and we seem to have recovered from that. So do they keep going until they break something? And when do we see something breaking?
How about this for a revolutionary concept, Scarlett? How about they don't break anything? Is that possible? I mean, I know there's all this economic theory that from people much smarter than us who say the only way that you can sort of reset on inflation, reset on the labor market, is for basically to break something. I wonder if maybe
you're going to go against the historical, you know, the historical data.
I'm not an economist, but I do play one on television. We are, of course, going to have full coverage of that decision tomorrow. Meanwhile, we do want to go back to the Plaza Hotel here in Midtown Manhattan. HSBC CEO now speaking in conversation with the former Bank of England governor, Mark Carney, about the climate crisis. Let's take a listen.
But, you know, otherwise we can't have a Western size fits all. That's not what it's meant to be. And secondly, the global capital markets works off standards and taxonomies that actually don't incentivize us to finance transition in emerging markets. Actually, they kind of pressure you to divest from fossil fuels, but they don't incentivize you to invest in transition finance. So if you take something simple like one of the most important targets is weighted average carbon intensity. If we did
Here's the setup for what markets will have their eye on Wednesday. A big Fed meeting.
It all comes down to that 2 p.m. meeting where the Fed comes out with its decision. No change there, right? They're going to pause. But what they say and what kind of projections they have for the rate hikes going forward, or maybe not.
Yeah, it'll be interesting. We'll have full coverage here. Team Surveillance and Team The Close will be guiding you through the day. UK inflation also going to be coming out in the morning. And we get earnings tomorrow, believe it or not.
And from an economically sensitive company, too, FedEx.
Yeah, FedEx. And, of course, get a couple others in the morning. And there's an event that Amazon is holding on devices, which I think is interesting because they've been scaling back that business.
What happened to Fire?
I don't know, Scarlet Fu. We're going to find out tomorrow. Stick with us. This is Bloomberg.